Hello, welcome to the budget and economic survey discussion. And this is the next video in the series of videos that we are making on budget and economic survey. In this video, we are going to discuss the chapter 2 from economic survey 2024, where we are going to discuss about the monetary and financial sector developments. That means in this chapter, we are going to discuss about the extent of the money supply, the money multiplier effect, and financial sector developments like the health and performance of the banking sector, the trends in the credit dispersal by the banking sector, and the other issues involved with the banking sector, and also the dynamics of the capital markets. Okay, so let me tell you, this is predominantly a prelims centric topic. So we are going to discuss only those aspects that are mentioned in the chapter 2 of this economic survey, which is relevant to this year's prelims examination point of view. Okay, and right after each and every topic is done, we are going to discuss certain MCQs as well. Okay, so let's start with monetary developments first. Monetary developments, that means the developments with respect to the money supply. Okay, as we all know, the money supply responsibility is with the central bank, which is Reserve Bank of India. And economic survey, this economic survey has specifically mentioned about the money multiplier effect. It says that the money multiplier increased in Indian economy in the last 2 financial years. So to understand what reasons enabled this money multiplier to be increased, we need to understand what exactly is money multiplication process. So let's start with money multiplication process, because that is where you expect questions in the prelims. Okay. First of all, I'll explain you what is money multiplication process, and then we'll discuss about the factors which aids this growth of money multiplication process. Okay. So let's take a very hypothetical example where there are only 4 individuals in an economy. Okay, this is a hypothetical example. Okay. And let's say the first individual, Mr. A, he possesses 100 rupees of currency note with him. And let us assume that that is the only money that is available in that particular economy. Okay. So this Mr. A, who possesses 100 rupees of currency note, that money has been deposited in the bank. Right. See, whenever bank receives deposits, it uses that money for further credit creation. That means the deposits received by a bank is going to be used for lending to the other customers. Okay. However, the entire money that is received in the form of deposits cannot be utilized for credit creation, because banks have to keep a certain amount of the money to meet their reserve requirements, and we call it reserve ratio. What are these reserve requirements? CRR, SLR. These are the reserve requirements. That means CRR refers to the amount of the cash that the banks have to keep with the RBI. SLR refers to the amount of the deposits, the share of the deposits that the banks have to keep with themselves in the form of liquid assets like cash, gold, or any other designated securities like government securities. Right. So the entire deposits that received by a bank is not available for lending purpose. A certain portion is actually kept aside to meet their reserve requirements. In this example, let's say when Mr. A has deposited 100 rupees in the bank, let us assume that reserve ratio is 20%. That means both CRR and SLR together makes up to 20%, which means 20 rupees have been kept aside by the bank to meet its reserve requirements. And guess what? 80 rupees is actually available with the bank for further credit creation. And let's say 80 rupees is being given as loan to another individual, Mr. B. Right? Now, whenever a bank gives loan to a customer, a savings account is actually opened in the bank and the money is deposited in the bank. And the money is deposited in that particular account. So when the bank has given 80 rupees of loan to Mr. B, the money is actually deposited in his account. That means B has 80 rupees in his account. So on paper, Mr. A has 100 rupees in his deposit and Mr. B has 80 rupees in his account. That means the total money right now is actually 180 rupees at this stage. See, what is money? Money refers to the total currency held with the public and also the amount of deposits made by the public in the banking sector. So Mr. A has deposited 100 rupees. So that is his money. And 80 rupees has been deposited in the account of Mr. B, which is his money. So the total money is actually 180 rupees. So you will understand it better how the money is actually multiplied with further steps. Let us say in this example, let's say Mr. B, when he receives 80 rupees in the form of loan in his account, in the form of deposit, let us assume that he has not withdrawn a single rupee from his deposit account. And the entire 80 rupees is available with the bank and retained in the form of deposit within the bank. Now, out of this 80 rupees of deposits, bank has to keep 20%, which is 16 rupees in the form of reserve requirements, and 64 rupees is available with the bank for further credit creation. That means 64 rupees loan has been extended to another customer, let's say C. So when the loan is given, the amount is actually deposited in the account of Mr. C. That means the money supply at this stage is actually 180 plus 64, which is 244. And the cycle continues. Let us assume that Mr. C also has not withdrawn a single rupee from his account, and out of 64 rupees, 20%, which means 12 rupees, has been kept aside by the bank to meet its reserve requirements, and 52 rupees is available with the bank for further lending. And let's say this 52 rupees is given as loan to Mr. D. And Mr. A has 80 rupees, Mr. A has 100 rupees in his account, B has 80 rupees in his account, C has 64 rupees in his account, and Mr. D has 52 rupees in his account. That means the total money supply at this stage is actually 296 rupees. See how a single 100 rupees currency note has created a money of 296 rupees. So this is how money multiplication is done in the banking system. So that means whenever a currency note enters the banking system, it multiplies the money in the regular process of credit creation. So money supply or money multiplication is a byproduct of credit creation by the banks. So this process is known as money multiplication through fractional reserve banking system. What is fractional reserve banking system? Which means out of the total deposits received by the bank, a certain fraction is actually kept aside for reserve requirements, and the rest of the money is actually given as loans to the other customers, which will end up creating money or multiplying the money and increasing the money supply. So this is what money multiplication. Money multiplication means whenever the bank note, which means the currency note, enters the bank will make further lending, and that itself creates money. Okay. So now that you understand the basic of money multiplication process, let us understand the factors which determine this money multiplication process. Let us understand these factors through further examples. Let us take another example, a similar example. The same example where Mr. A has 100 rupees in his pocket, which he deposited in the bank. Now, in this example, we are making some changes. Let us say in this example, the reserve ratio is actually 10%. That means banks have to keep 10% of the deposit money to meet their reserve requirements, and the rest of the 90% of the money is available with them for further credit creation. So out of this 100 rupees deposited by Mr. A, 10 rupees has been kept aside by the bank to meet its reserve requirements, and 90 rupees of the money has been available with the bank for further credit creation, which it has given loan to another individual, Mr. B. Of course, whatever the loan that is given is deposited in the account of the Mr. B. Now Mr. B has 90 rupees in his account. Now let's make the same assumption that we have made in the previous example, where let us assume that even Mr. B in this example has not withdrawn a single rupee from his account. Then the entire amount of the loan that he received has been retained with the bank itself. Now out of this 90 rupees of deposits, bank has to keep 10% of the money to meet its reserve requirements, which is 9 rupees, and rest of the 81 rupees is actually available with the bank for further credit creation. Let's say 81 rupees has been given as loan to Mr. C, which is deposited in the account of Mr. C. That means now A has 100 rupees in his account, B has 90 rupees in his account, and C has 81 rupees in account. So the total money supply at this stage is actually 271 rupees. And the cycle continues to the fourth stage, where out of this 81 rupees, let us assuming that C has also not withdrawn a single rupee from his account, the total money that he has received in the form of loan in his account has been retained completely. So out of this 81 rupees, 8 rupees has been kept aside by the bank to meet its reserve requirements, and rest of the 73 rupees is available for further credit creation, which is given to Mr. D in the form of loan, which is subsequently deposited in his account, and hence Mr. D has 73 rupees in his account, which increases the money supply to 344 rupees. See, how is it different from the previous example? Here, the same amount of 100 rupees has entered the banking system in both the examples, but the money supply in the second example is higher than in the first example because the reserve ratio is less here. That means when the reserve requirements are lesser, the money that is available with the bank for credit creation is more, which creates more money. Unlike in the previous example where reserve ratio is only around 20%, the money is actually 80 rupees available at the first stage, but here 90 rupees is available in the first stage. So money multiplication is indirectly proportional to reserve ratio, which means when reserve ratio decreases, money supply is going to be increased, which means money multiplication is going to be increased. And that is why we often see that whenever Reserve Bank of India wants to increase the money supply in the market, it reduces CRR or reduces SLR. Okay. So this is one factor which determines the extent of money multiplication in the economy. Now let us look at the other example and find out what is the other factor which determines this money multiplication process. See, in the previous two examples, there were few assumptions that we have made for the sake of understanding. Here, Mr. A, who possessed the 100 rupees currency note, he deposited the entire 100 rupees in the bank. And whenever the loan has been given to Mr. B, C and D, in the two examples, we made an assumption that none of them had received, none of them had withdrawn a single rupee from the bank, and they retained the entire amount of the money within the bank itself. Now let's make some changes to the next example, where let's say Mr. A, who possesses 100 rupees in the first place, instead of depositing the entire 100 rupees in the bank, he has kept 50 rupees in his pocket and 50 rupees in the bank deposit. So that is important here. Let's say Mr. A held 50 rupees of currency in his pocket and 50 rupees is deposited in the bank. That means, unlike in the previous two examples, instead of 100 rupees, 50 rupees has entered into the banking sector. That means the deposits have been reduced here. The amount of deposit has been reduced here. Now, since the amount of deposit has been reduced, they will have less amount for further credit creation. Because out of this 50 rupees, they have to keep certain amount of the fraction in the form of reserve requirements. Let's say if the reserve ratio is 10%, they have kept aside 5 rupees to meet their reserve requirements, and rest of the 45 rupees is utilized for further credit creation. That means 45 rupees is actually given in the form of loan to Mr. B. See, the money supply at the first stage when the individual A has deposited the 50 rupees in the bank is actually 100 rupees. Because what is money? Money refers to the total currency held by an individual and also the money that is deposited in the bank. So 50 rupees is held by the individual and 50 rupees is deposited in the bank. So total money is 100 rupees. But money supply will be less here because only 50 rupees is with the bank now. Out of this 5 rupees has been kept aside and 45 rupees of loan has been extended to Mr. B, which is deposited in his account. However, out of the total loan given to Mr. B, unlike in the previous two examples, he has actually withdrawn certain amount of the money. Let us say 50% of the money has been withdrawn by Mr. B and only 50% is actually retained in the account. That means 22.5 rupees currency is held by the Mr. B in his pocket and 22.5 rupees is retained in the bank. That means bank deposit is only 22.5 rupees here. That means after keeping 2.25 rupees for the reserve requirements, only 20 rupees is actually available with them for further credit creation. And money supply at this stage is actually the 100 rupees in the first stage and 45 rupees in the second stage. Why 45? Currency held is actually 22.5 rupees by the Mr. B and deposits made by the Mr. B is actually 22.5 rupees, which is 45 rupees. So the total money supply at this stage is actually 145 rupees. And this 20 rupees is given as loan to Mr. C. Out of this 20 rupees, Mr. C has withdrawn 10 rupees and kept in his pocket and 10 rupees is retained with the bank. So the total money supply is actually 145 plus 20 rupees is 165. By the time they reach the third stage, the money supply is actually 165, whereas in the previous example, at the third stage, the money supply is much higher, 271 in this case and 244 in this case. So there is a significant decline in the money supply in this example because the amount of deposits held with the bank is lesser in this example. So the amount of the deposits is also a factor which determines the money supply and money multiplication in the economy. So how much of deposits are you making or retaining with the bank is important for the money supply and money multiplication. This is actually determined by a measure currency deposit ratio. Currency deposit ratio means the currency held with the public by deposits made in the bank. Currency held with the public by deposits made in the bank. So this is currency deposit ratio. In the previous example, none of the stakeholders A, B, C, D has not kept a single rupee in their pocket. So the currency held with them is actually zero. So in this example, currency deposit ratio is actually zero. But whereas in this case, they have retained 50% of the money in the bank and rest of the 50% of the money has been withdrawn and held with them in the form of currency. That means the currency deposit ratio is 1 here, isn't it? So when the currency deposit ratio increased, the money supply reduced because the money multiplication process reduced, because when the amount of deposits is reduced, when the amount of deposits or the quantity and the share of the deposits reduces, then it will have an impact on the money multiplication process. So the second factor which determines the money multiplication is actually the currency deposit ratio. It is also inversely proportional to the currency deposit ratio, which means the propensity of the consumers, the propensity of the public to deposit their currency in the bank is going to determine the money multiplication process. If people would want to prefer to keep their money in the form of currency but not in the form of deposits, then the money supply cannot be increased. And that is why the interest rates are actually, deposit interest rates are increased to attract customers to come and deposit their money in the bank so that the money supply can be increased. And that is why RBI from time to time change its key policy rates to change the interest rates so that the money supply can be altered according to its objective. So now that you understand the factors which determine the money multiplication process, let us also understand what exactly is money multiplier, because this is what mentioned by the economic survey, this year economic survey specifically. What is money multiplier? Money multiplier is nothing but the number of times the money has been multiplied by the bank. That's it. In this example, when 100 rupees currency note has entered the bank, it has resulted in money supply of 296 rupees. That means it has created a money of 296 rupees. That means money is multiplied by 2.9 times. In this example, the 100 rupees which has entered the banking system has resulted in creating a money of 344 rupees, which means the money multiplier is actually 3.4. But in this case, the money that has been 50 rupees that has entered has resulted in 165 rupees. So the money multiplier is reduced here, right? So money multiplier is calculated by the total money supply by the reserve money. Reserve money is indicated by M0. What is reserve money? The reserve money is actually the 100 rupees held by the individual. Here the 100 rupees held by the A, because that is the base money which has created this money. So reserve money refers to the total stock of currency notes held by the public and also in circulation. The total currency in circulation, that is what the reserve money. And the currency held by the banks, that is what reserve money. Okay. So money is multiplier equal to total money supplied by the reserve money. In this case, reserve money is actually 100 rupees. In all these three cases, reserve money is actually 100 rupees, which created 296, 344 and 165 rupees respectively. So this is what the money multiplication, this is how money is multiplied. Okay. So why are we discussing this? Because this year, the economic survey has said that in the last 2 years, especially from 2022, we have seen increase in the money multiplier. In 2022, the money multiplier is actually 5.2. Now it increased to beyond 5.5, which means around 5.6. Money multiplier increased to 5.6 in the last 2 years. If you see how the money multiplier increased in the last 2 years. Now, what is the reason for this increasing in the money multiplier? There are only two factors. One is actually reserve ratio and other is currency deposit ratio. That means the propensity of the population to deposit their money in the bank. Okay. So the first factor played a very significant role in increasing the money multiplier in the economy in the last 2 years. That means the reserve ratio reduced because RBI has slashed cash reserve ratio to 4% from 4.5%. Earlier it used to be 4.5% and it has been reduced to 4%, and that has resulted in reducing reserve ratio and increasing availability of the money for further credit creation, and hence it increased money multiplication process and hence it increased money supply in the economy. So this is the crux of this extent of money supply that was actually mentioned by the economic survey this year, and there is nothing much to it. This understanding is more than enough for you to answer any question on this topic. Okay, so let us solve some questions and you will get better clarity on this topic. Let's see. Look at this question number 2 first. Which of the following statements correctly describes what the money multiplier measures? Money multiplier. Option A measure that shows how changes in government spending affect a country's economic output. This is wrong. This refers to fiscal multiplier. It means how much of money is spent by the government and how much of output it has resulted into. That is known as fiscal multiplier. It has nothing to do with the money multiplier. Okay. Option B. the amount of money that a banking system generates with each unit of central bank money. Read this statement again. The amount of money that a banking system generates with each unit of central bank money. What is central bank money? The currency. Whenever the currency enters the banking system, how much of money it is going to be created? That is what money multiplier is. That's what we have explained in the previous 3 examples. So option B is the right answer. Right. Let's look at the question number 1. The money multiplier in an economy increases with which one of the following? Option A, increase in the cash reserve ratio in the banks. Wrong. In the previous example, we have seen that money multiplier is inversely proportional to the reserve ratio. If reserve ratio is increased, the money available with the bank for further lending creation is actually going to be reduced, and hence the money multiplier effect is going to be reduced. So increasing the cash reserve ratio in the banks is not the right answer. Increasing in the statutory liquid ratio in the banks will have the same effect. So this is also wrong. Increasing in the banking habit of the population. Increasing in the banking habit of the people. Yes, this is right. What is the second factor? Currency deposit ratio. That means how much of the money that is held by the individuals with respect to the amount of the money that they have actually deposited in the bank. That is what currency deposit ratio. Which means when people are preferring to keep their money in the form of deposit rather than keeping the money in the currency in their pocket, then that will increase the money multiplier effect. So increasing banking habit of the population is going to increase the money multiplier in an economy. So the right answer is C. This is the previous year question which was asked twice by the UPSC. Okay. So this is about money multiplication process and money multiplier, and that's it with respect to the monetary development that was mentioned in the economic survey. Now let's get into the banking sector and let's see what has been discussed by the economic survey in the banking sector. First of all, economic survey has discussed about a lot of aspects with respect to the banking sector, but to appreciate this discussion, you need to have basic understanding of the structure of the banking sector in India. The structure of the banking sector, the broad structure of the banking sector is something like this. See, RBI is the epicenter of the banking sector because it regulates the banking sector. And the banks are actually broadly categorized into 3 categories: scheduled banks and non-scheduled banks and development banks. What are scheduled banks? Scheduled banks are actually those banks which are mentioned in the second schedule of RBI Act 1934. Second schedule of RBI Act 1934. These banks are known as scheduled banks, and those banks which are not mentioned in the schedule 2 of RBI Act 1934, they are considered as non-scheduled banks. Examples of non-scheduled banks are local area banks. Local area banks are actually the small banks which have niche banking purposes, and their area of activity is also very localized, and the extent of the RBI's regulation over these non-scheduled banks is very minimal compared to the scheduled banks. Okay. So scheduled banks are very important for the economy, and that is why they are heavily regulated by the Reserve Bank of India. So these scheduled banks are actually divided into 2 parts, 2 categories: commercial banks and cooperative banks. The purpose and nature of commercial banks are slightly different from the cooperative banks. And under scheduled commercial banks, we have multiple types of banks. Public sector banks, where those banks where the majority ownership is held with the government, these banks are known as public sector banks. And private sector banks, where the majority shareholding is with the private participants, then these are private sector banks. And foreign banks are operated in India either as subsidiaries or branches, or opening their branches in India. And we also have certain differentiated banks like regional rural banks, small finance banks, and payment banks. These banks are actually unlike the other universal banks. They have very differentiated, they are known as differentiated banks, and they have niche purpose. Okay, we are not getting deeper into the purpose of each and every bank, because we have a lot to discuss about the nature of the credit and other aspects that is mentioned in the economic survey. Okay, And cooperative banks are broadly of two types, urban cooperatives and rural cooperatives. And rural cooperatives is further has three types structure: primary agriculture credit societies, district central cooperative banks, and on top of it, state cooperative banks. Okay. This is about scheduled commercial banks and development banks. Development banks are dedicated financial institutions which are developed by the government for developing a particular sector of the economy. That means they have a dedicated purpose, unlike these banks. For example, let's take NaBFID. NaBFID gives loans for the agricultural and rural development. SIDBI is to develop the small industrial sector. National Housing Bank is to finance the housing sector and make sure that housing facilities are available to each and every section of the population at affordable cost. Exim Bank provides export credit, and NaBFID, the latest addition to this developmental banks category, is NaBFID, National Bank for Financing Infrastructure Development. This is a dedicated developmental financial institution for infrastructure development in India. All these developmental financial institutions are considered as All India Financial Institutions. They have got the tag of All India Financial Institutions and they are regulated by RBI under RBI Act 1934. So we'll discuss more about these developmental banks, especially the NaBFID, because this is very important and specifically mentioned by this year economic survey. So you can expect a question on NaBFID this year. So this is a broad division of banking sector in India, broad structure of the banking sector in India. Okay, now that you understand the broad structure of the banking sector, let us understand the trends in the credit distribution by the banking sector, especially the scheduled commercial banks. Okay. So first of all, we look into the sectoral distribution of credit disbursed by the banks in India. Out of the total credit given by all the scheduled commercial banks in India, agriculture sector receives 13% of the loans. Industrial sector receives 23% of the loans. Industrial sector includes both large industries and also MSME sector. And service sector receives 30% of the total loans. Service sector loans like loans given to, let's say, IT industry, loans given to transport and communication industry, loans given to, let's say, real estate. All these are service sector loans. And also loans given by the bank to NBFCs is also considered as a service sector loan because it is a financial service. So loans given by the bank to NBFCs are also considered as service sector loans. So out of the total loans given by the scheduled commercial banks in the economy in the last financial year 23-24, 30% of loans have been given in the service sector. And comes this personal loan category, which is the highest. This sector received the lion's share of the total credit disbursed in the economy by the scheduled commercial banks. 34% of the total loans were given to personal loan category. What are these personal loan category loans? Like education loan, vehicle loans, credit card loans, we also call it consumer credit, retail credit, personal loan credit, right? So this category received the highest share. So contrary to the popular perception, it is not the agriculture or industry, but it is the personal loan category which received the highest share of the total credit disbursed by the scheduled commercial banks in India in the year financial 23-24, and the trend has been similar in the last 4 years. It's not that it is one of a case in the last one financial year. The trend has been similar since many years. So banks are preferring to provide loans mostly in this sector compared to the agriculture sector. So now that you understood the sectoral distribution of the credit dispersal by the banks, let us understand the distribution of NPS. So in which sector the probability of NPA is higher? It is the agriculture sector. See, in the agriculture sector, the GNPA ratio is actually 6.2%. That means out of the total loans given to the agriculture sector, 6% of the loans have turned out to be NPAs, or non-performing assets. What are non-performing assets? Non-performing assets are those loans which are defaulted at least for a period of 90 days. Okay. For industry sector, it is the number is actually 2.9%. That means which is around 3% of the loans given to the industrial sector have turned out to be non-performing assets. And the number is actually 3% for the service sector, which means out of the total loans given to the service sector, 3% of them have become non-performing asset, and the number is lowest for retail or personal sector, which is only 1.2%, which means only 1.2% of the total loans given to the personal loan category turned out to be non-performing asset. That means the probability of non-performing asset is very less in this sector and more in this sector, in the agriculture sector. Right. So this is what the GNPA ratio of various sectors. Right. And let us understand a few other trends in the credit disbursal by the banks, and then we'll solve some questions based on this information. Okay. This is very important because questions can be asked in prelims based on this information. Now that we understood the total credit disbursed by the banks, let us find out what about the priority sector lending by the banks. See, what is priority sector lending? The Reserve Bank of India has mandated all the banks to deliver a certain amount of credit to priority sectors. What are these priority sectors? Agriculture, small enterprises, loans given to weaker sections, export credit, loans given to renewable energy. All these sectors are considered as priority sectors, and RBI mandated that each and every bank has to give a certain amount of the total credit to these priority sectors. And the priority sector lending targets are like this. For public sector banks, priority sector lending targets are actually 40%. For private sector bank, it is the same 40%, and even for the foreign banks, it is 40%. But for small finance banks, the priority sector lending target is actually 75%. And for urban cooperative banks, it is also 75%. Remember, these two are actually those kind of banks which have a defined purpose. That means small finance banks are actually established to make sure that the underserved population, especially the agriculture, weaker sections, and also small industries, receive loans from the banking sector. So to enhance the financial inclusion, small finance banks have been established by the government. And that is why for them priority sector lending targets are much higher than the priority sector lending targets of the rest of the banks. The same thing goes with the urban cooperative banks also. It is 75% for them. So these are priority sector lending targets. But when it comes to the absolute credit given by the banks in terms of this priority sector lending categories, public sector banks have the lion's share. That means out of the total priority sector loans given by the banks in India, more than 50% of the loans were actually given, loans originated from public sector banks. And 39% of the total priority sector lending loans were actually given by private banks. Foreign banks have given 4% of the total priority sector lending loans, priority sector loans in the economy. And the contribution of small finance banks and urban cooperative banks is very meager. It ranges from 2% to 3%. It ranges from 2% to 3%. So now you must be wondering, despite having higher targets for these two banks, their absolute contribution towards the total priority sector loans is very meager because their scale of operations and the size of credit is actually much lesser compared to these universal banks. The outreach, scale of operations and the size of loans given by the public sector banks is actually much higher. And that is why their 40% is much higher than the 75% of these loans given by these banks. So this is about priority sector lending credit given by the banking sector in the economy. Okay. So based on the information, let us solve some questions. Look at the question number 3. Please mention your answers, write down your answers in the comment section. And don't forget to mention the question number. Right. Question number 3. Consider the following statements with respect to the sectoral distribution of credit by scheduled commercial banks in India. The agriculture sector receives the majority share of total credit disbursed by the scheduled commercial banks in India. The statement is wrong. Only 13% of the total credit disbursed by the scheduled commercial banks is diverted towards agriculture sector. However, the highest share is actually given to personal loan categories. Okay. Second, the gross NPA ratio is highest in personal loan category. Again, wrong. For personal loan category, the gross NPA ratio is only 1.2%. That means out of the total loans given by the banks in that category, only 1.2% of them are actually non-performing assets. In fact, the highest is actually for agriculture sector, where the number is 6.2%. That means out of the total loans given by the banks in the agriculture sector, 6% of them have become non-performing assets. So both the statements are wrong, and hence the answer is D, neither one nor two. Okay. Now look at the question number 4. Which of the following categories of banks operating in India are not required to observe the priority sector lending targets? Okay. Which of them are actually not required to observe the priority sector lending targets? First and foremost, let's look at this. Small finance banks. We have already discussed that for small finance banks, the priority sector lending target is actually 75%. Okay. And let's look at the foreign banks. For foreign banks, the priority sector lending is actually 40%. However, for foreign banks with less than 20 branches, they don't have to observe the sub-targets in the priority sector lending targets. See, priority sector lending targets, that means 40% of the total loan should be given to this priority sector that we have discussed. But apart from that, most of these banks have to observe the sub-targets, like 18% should be given to agriculture, 10% should be given to weaker sections, 7% should be given to small industries, micro industries, like that. However, foreign banks with less than 20 branches do not have to subscribe to these sub-targets, but still they have to observe the overall target of 40%. So even foreign banks with less than 20 branches will have to observe the priority sector lending targets. Now we are left with the other 3 options: NBFCs, local area banks and payment banks. Now it is very easy to eliminate these payment banks, because see, payment banks do not give any credit. Payment banks only accept the deposit, and payment banks can be utilized for payment purpose, payment and settlement and other purpose, and sending the remittances. For this purpose, payment bank has been established, but payment banks are not supposed to undertake any lending activity. When there is no lending activity, there is no priority sector lending targets. So payment banks do not have to observe any priority sector lending targets. Okay. Now local area banks. See, local area banks are actually non-scheduled banks. That means the amount of regulation over these banks by the Reserve Bank of India is relatively lesser compared to other banks. But still, even local area banks are supposed to maintain or observe 40% of the priority sector lending targets. Even though their area of operation is very less, these local area banks are also supposed to observe 40% of priority sector lending targets as prescribed by Reserve Bank of India. So even local area banks are supposed to observe. Now you are left with NBFCs. NBFCs are not mandated to observe any priority sector lending targets. See, most of the times banks may take the help of NBFCs to meet their priority sector lending targets, because NBFCs have got good presence in the rural areas. So that is why they can get the right customers. So banks rely upon the NBFCs. So banks tie up with the NBFCs to give the priority sector lending loans. But NBFCs, they themselves do not have any such targets. So NBFCs and payment banks, 1 and 4, option B is the right answer. Right? So priority sector lending is very important. Next, look at the question number 5. Consider the following statements. The priority sector lending target of urban cooperative bank is more than that of scheduled commercial banks. Priority sector lending of urban cooperative banks is 75%, and for the rest of the scheduled commercial banks it is 40%. So the first statement is right. Okay. Now look at the second statement. Urban cooperative banks deliver more credit in PSL categories in comparison to the scheduled commercial banks. Now this is the wrong statement, because though the targets are higher for urban cooperative banks, but when it comes to the overall share of the urban cooperative banks in the total priority sector loans given in the economy, their share is hardly 3%, because their size of operations and scale of operations and the loan size is actually very less. So the statement 2 is actually wrong. So the option A is the right answer. Right. So this is about the sectoral distribution of the credit given by the banks, and also NPA share of the each and every sector. Okay. Now let's get into the other aspect which was mentioned by the economic survey, is with respect to the health and performance of the banking sector. See, the health and performance of the banking sector is measured by two important parameters. The first parameter is actually NPS. How much of NPS are there in the banking sector? And second measurement is the capital adequacy. How much of capital is actually maintained by the banking sector? So let's discuss about the first parameter, the NPS. Okay. What is NPA? NPA is actually a loan given by a bank, which is considered as an asset, obviously. So an asset of a bank, or a loan given by a bank which has been defaulted for a period of at least 90 days. So you know that when a bank is accumulated with more amount of NPAs, then it reduces the profitability of the bank. And not only that, it also reduces the lending capacity of the bank. So accumulation of NPAs in the banking sector is a serious concern, because it may lead to the financial instability. So let's see what is the state of NPS in India. According to the economic survey, the gross NPAs of scheduled commercial banks in India have been significantly reduced over the last 7 to 8 financial years. That means in March 2018, in the 2018 financial year, the gross NPAs, that means the total amount of NPAs in the economy, the total number of NPAs accumulated by all the scheduled commercial banks together is around 11%. 11% of the total loans, and that has been reduced to 2.6%, which is a very significant improvement in terms of the health of the banking sector. It is a very good sign. Right. So what reasons have been aided this improvement in the health of the banking sector? Before understanding the reasons, we need to understand gross NPA, difference between gross NPA and net NPA. Because what exactly is gross NPA, and why did you use the word gross? Why can't we just say total NPS? See, what is gross NPA? Gross NPA means the total number of, or total amount of non-performing assets accumulated by a bank. That is gross NPA of that particular bank. However, net NPA means when the provisioning coverage ratio is deducted from the gross NPA, then we arrive at net NPA. To understand what exactly net NPA, you need to understand the purpose and significance of this provisioning coverage ratio. What is provisioning coverage ratio? Provisioning coverage ratio refers to the amount of the money that the banks have to set aside against the bad assets. The amount of the money that the banks have to set aside, mostly from the profits, against the stressed assets. This will give a cushion to the banking sector in the event of any default down the line. And this will help the bank to sustain their business as usual and run the bank. So that is what the significance of provisioning coverage ratio. That means banks have to set a certain amount of the money against each and every asset, each and every loan, depending upon its asset category. Let's say the assets have been divided into 4 categories depending upon the degree of the stress faced by that particular asset. That means if it is a standard asset, let's say what is a standard asset? Standard asset is that asset which is actually working just fine, which means that loan which is not at defaulted and the bank is receiving regular EMIs both for principal amount and interest amount regularly. That asset is considered as standard asset. For standard assets, the bank has to keep 0.25 to 0.4% of the money or the total asset value in the form of provisioning requirement. This money should be taken from the profits, right? And if it is a substandard asset, so you must be wondering, if it is a standard asset, why should there be a provisioning? Because even it is a standard asset right now, there are high chances that any asset may become a stressed asset or a non-performing asset down the line. So that is why for safety, it's very meager amount like 0.25% is actually kept aside, depending upon the type of the loan. If it is an education loan, it's different. If it is real estate loan, the provisioning amount will be different, like that. Okay. Now the next category of asset category is actually substandard asset. That means substandard asset is an asset where the asset has been NPA for 12 months. That means what is NPA? The loan which has been defaulted for more than 90 days and it has remained NPA for 12 months, up to 12 months, then that asset is known as substandard asset. If the asset becomes substandard, then banks have to keep 15 to 25% of the total asset value as provisioning requirement or provisioning amount, because the risk has been higher, so provisioning amount is also higher. The degree of stress is higher, so provisioning amount is higher. Depending upon the duration, for example, if it is NPA for 3 months, it is 15%. If it is NPA for 6 months, it is, let's say, 20%. If it is NPA for 12 months, then they have to keep 25% amount of the money. So this money is going to give the bank a cushion in case of any default. Next, doubtful asset. Doubtful asset is actually that asset which has been substandard up to 12 months. That means the degree of stress is much higher in this case. In this case, the provisioning amount is higher than in the previous case. 25 to 100% of the total asset value should be provided in the form of provisioning coverage ratio out of their own profits, out of the profits of the bank. And the fourth category is actually loss asset. Loss asset refers to that asset which the bank is considering that there is no hope of recovery. That asset which is considered as irrecoverable by the bank. In that case, for the degree of stress is very high, so a total of 100% of the asset value should be kept aside in the form of provisioning requirement from their profits. So even if the asset is completely lost, they can still run their business because they have made a cushion against this asset. So this is the provisioning coverage ratio, right? So that is why whenever we talk about NPA problem, we just not have to look at only the gross NPAs, because against these NPAs, the banks are also providing certain amount of the money in the form of provisioning coverage ratio. So the real risk is only at net NPA. The real risk is actually net NPA. So to understand the right health of the banking sector, often net NPA is actually preferred over gross NPAs. So that is the difference between gross NPA and net NPA, right? So again, as the economic survey mentioned, that the gross NPA ratio has been significantly decreased. So when the gross NPA reduces, the provisioning burden is also going to be reduced by the reduced for the banks. So it is also going to reduce net NPA as well. Okay, now clear. Now let us look into the reasons. How did we arrive at this situation? That means how could the banking sector improve its performance in terms of declining gross NPA ratio? There are multiple reasons, and the first and foremost reason and the most important reason is actually writing of loans. Banks have written more than 10 lakh crores of loans in the last 5 years. Indian banks have written off more than 10.6 lakh crore in the last 5 years. So this is very important for this year prelims. Okay, so let us understand what exactly is loan write-off, what is the mechanism of writing of loan, and why do banks prefer loan write-off, and what will happen to such loans once they are written off. So what is the impact on the banking sector? So we'll discuss all these aspects. First of all, what exactly is a loan write-off? We keep hearing this writing of loan, a certain amount of loan has been written off by so and so bank in the newspapers. So loan write-off means not loan wive-off. That means they're not wiving off the loan. They're just removing the loan from their balance sheet. So loan write-off is a mere accounting exercise where the toxic assets or the bad assets are actually removed from the balance sheet of the bank. So this is an activity or exercise of cleaning the balance sheet of the bank. So what exactly this process? What do you mean by cleaning of the balance sheet? For that you need to understand the balance sheet of a bank. So balance sheet of a bank broadly comprises of two aspects. One, liabilities, and second, assets. Okay. So what are the liabilities of a bank? These liabilities of a bank are actually mentioned in the liability section, like deposits. A deposit is actually a liability. So the total amount of deposits received by a bank is mentioned as a liability. And second aspect is the provisioning requirement. The provisioning amount that the banks have to keep against this stressed asset is a liability, because they have to bring from their own profit and then keep with against the stressed asset. So the provisioning coverage is also a liability. And all the capital raised by the bank from the market in terms of either equity or in terms of bond, they are also considered as a liability. So capital, either equity capital or debt, that is also liability, because they have to give either dividends or the interest rate for raising this capital. So that is a liability for them, right? So these are liabilities. And what are the assets of a bank? Obviously the loans extended. All the loans given by the bank are considered as its assets. And investments made by the bank, like apart from giving the loans, banks also make some investments, like investing in government securities, best example. Okay. And these are loans and assets. These are liabilities and assets. Okay. Now, see, we are not getting deeper into the balance sheet of the bank. So we are actually writing down only those important entries in the liabilities and assets to understand how a loan write-off procedure is actually undertaken by the bank. So whenever we say that a loan is written off, we mean that out of the total loans extended by the bank, certain amount of loans are actually removed from this assets section, right? That means, let's say if a bank has written off 1000 crores of loan, that means 1000 crores of loans is actually removed from this entry. And it's not that the loan is actually disappeared into thin air. No, it should be accounted as losses incurred by the bank in that particular financial year. For example, whatever the amount of the loan that has been written off from the asset section, from the loan section, should be included in the form of losses in the balance sheet. This is loan write-off exercise. This way they can actually clean their bank, asset section. Their balance sheet is actually cleaned, even though they incur losses, but the balance sheet looks healthier, right? Now you tell me, why to make their balance sheet healthier and why to record losses by removing the loans or bad assets from the asset section? There are two reasons why banks often undertake loan write-off exercise. The first and foremost is actually to reduce the provisioning coverage ratio burden. As we have already seen in the previous slide, the provisioning amount should be kept aside by the bank against this stressed asset. Let's say if the degree of the stress is increasing, their provisioning requirement is also increasing. For a loss asset, they have to keep a total of 100% of the asset value as provisioning amount. And where are they supposed to bring that provisioning amount? They have to bring it from their own profit. It's not that they can take the deposit amount and provide it as a provisioning coverage ratio against this trust asset. No, they cannot do it. Nor they can raise the capital from the market and use it as a provisioning coverage ratio. No, they have to cut down their profits. They have to cut down their profits, overall profits, and use the profit amount for the provisioning coverage ratio. That means as long as the asset is actually mentioned in the toxic asset or the loss asset is actually mentioned in the balance sheet, you have to make the required or equivalent amount of the provisioning amount. Once it is actually removed, you don't have to keep the provisioning amount. See, the problem with providing huge amount of money is actually they're not only reducing the profit, but also the problem is actually that amount which is kept aside for the provisioning requirement should not be utilized for any other purpose. It is not that they can invest that money somewhere. They have to keep the money against this stressed asset, and that is a dead capital. If they clean their asset, if they clean their balance sheet by removing the toxic asset, they can use the provisioning coverage ratio. They can use the provisioning amount for any other purpose, because once the asset is removed from the balance sheet, they don't have to keep the provisioning amount anymore. So that is the reason why banks often prefer writing off the loans, because it reduces the need for the provisioning and it unlocks the dead capital that has been lying idle in the form of provisioning coverage ratio. Right. And there is another reason why the banks often take this writing of the loan, undertake this written off exercise is that to reduce their tax burden. See, as long as a loan is actually a bad asset, let's say a loss asset is mentioned in the asset section, it is not recorded as loss. Once it is removed from the asset section, it is recorded as loss. So once it is recorded as loss, the overall profit of the bank is going to be reduced for that particular financial year. See, at the end of the financial year, every bank tallies their liabilities and assets in the balance sheet, and they find out whether they recorded profits or losses. By removing the assets, or by writing off the loans and by removing the loans from the asset section and entering them as losses, the overall profit of the bank is going to be reduced, and hence the net tax liability is also going to be reduced, because banks have to pay tax on their profits. Banks have to pay tax on their profit because it is just like any other company which has to pay the corporate tax. So tax benefit is one more reason why banks do prefer writing off the loans, because anyways they are paying the tax, anyways the asset is actually a loss asset. Instead of keeping it as a loss asset, if it is recorded as loss, real loss, then they can actually reduce their overall profit, recorded book profit, and they can reduce their tax liability, and hence this is also one of the reasons why banks do prefer writing off loans. Okay. Now the next question is, what will happen to the loans which have already been written off? Does it mean the banks are actually losing their right to recover such loans? Definitely not. As I told you, writing off loan is actually a mere accounting exercise. It is an internal exercise. It doesn't mean that they're letting go of their rights to recover that loan. That means banks still reserve the right to recover that loan, even though if it is removed from the balance sheet. They will continue to pursue the recovery of the loan in one way or the other way. Right. So banks do reserve the right to recover the written off loans. And let's say if they keep on pursuing the recovery of the loan, and in the future, down the line after 3 years or 4 years, if they really recover the loan, that loan is actually that is recorded as profit. That is recorded as profit in the balance sheet. Right. So any recovery made by the bank is recorded as a profit for the bank in that financial year, because once the loan is actually written off, it is recorded as loss in this financial year. If at all in the future the bank recovers that loan, that is actually again recorded in the balance sheet in the form of profit. So this is the status of written off loan. So now that you understand everything about loan writing of exercise, let us solve some questions based on this. So let's solve some questions on NPA, gross NPA, net NPA, provisioning coverage ratio, and loan write-offs. Okay, this topic is very, very important for this year prelims. Question number 6. Consider the following statements. The gross NPA asset ratio of scheduled commercial banks in India has consistently declined over the last 5 financial years. If you see, it has consistently, we have seen a consistent improvement in the gross NPA. It was 11.2 and it consistently decreased over the last 5 financial years. So yes, the first statement is actually right. First statement is right. And look at the second statement. This decline is attributed to increased provisioning by the banks. Read the statement again. The gross NPA ratio declined and that decline is actually attributed to increased provisioning by the banks. Wrong. Why? Because gross NPAs have nothing to do with the provisioning. Net NPA has something to do with the provisioning, because this is the formula of net NPA. Net NPA equal to gross NPA minus provisioning coverage ratio. If you increase the provisioning, it may reduce the net NPA, but it is not going to have any impact on the gross NPA. What is gross NPA? It is a sum total of the total NPAs, irrespective of how much of money you are actually keeping, how much of money the banks are actually keeping in the form of provisioning coverage. Right. So increased provisioning amount by the banks is a consequence of the gross NPAs, increased gross NPAs, but it has nothing to do with the causes of it. Okay, so the second statement is wrong. So option A is the right answer. Now let's look at this question number 7. Consider the following statements. Provisioning coverage ratio refers to the percentage of bad assets that the banks need to set aside from its profit. What is provisioning coverage ratio? The amount of the money that a bank is supposed to keep mostly from its profit against the stressed asset. That's what it is saying. So the first statement is actually right. Provisioning coverage ratio refers to the percentage of the bad assets that the bank has to set aside mostly from their profits. Right. Now look at the second statement. Banks do not need to maintain provisioning coverage for written off assets. Right. Banks do not need to maintain any provisioning for the written off assets, and for exactly the same reason why banks often undertake loan write-off exercise. We have already discussed it. So both 1 and 2 are right. Now look at the question number 8. Consider the following statements about loan write-off by a bank. Read the statements carefully. Banks lose their right of recovery after writing off a loan. Wrong. Banks still reserve the right to recovery. Okay. Look at the second statement. Loan write-offs may reduce the tax liability of a bank. Yes, it may reduce the tax liability of a bank because writing off the loan, when a loan is written off, it is recorded as loss in the balance sheet and it is going to reduce the overall profit and overall net tax liability of the bank, and hence it may reduce the tax liability of the bank. Yes, second statement is right. Third statement. Any recovery of the return of the loan is recorded as a profit in the balance sheet of the bank in that financial year. As I told you, if at all the bank recovers the loan in the future, that is actually again recorded back into inserted back into the balance sheet in the form of profit. So third statement is also right. So the answer is 2 and 3, B. Option B is the right answer. Okay. Now let's get back to the slide. What are we discussing? We are discussing about the reasons why the gross NPA ratio or the NPAs of banks have been declined significantly. Okay. So writing of loan is the first and foremost, reason for such decline. Then what are the other reasons? See, if you see, the decline has not started last year or before last year. It has started in the financial year 2018 itself. That means both the RBI and the government has made consistent efforts, combined efforts to improve the health of the banking sector, and these cumulative efforts have been resulted in significant decline and consistent decline of NPS over the period. That means the efforts have been started much before the financial year 2018. So what efforts have been made by the bank, RBI and the government to improve this NPA problem with the banking sector? So it all started with asset quality review. It is conducted in 2015. Asset quality review is an assessment study made by the RBI under the powers given to it under RBI Act 1934. It audited the accounts of all the banks. And understood the extent of NPA problem in the economy. So as I say, the first step of solving a problem is to recognize the extent of the problem or the degree of the gravity. Only then the RBI or the government can come up with suitable policy measures to address that particular issue. So to understand the extent of the issue, there should be an assessment study. So asset quality review is actually a review study made by, or assessment study made by the Reserve Bank of India with respect to the NPA situation, and they found out that the NPA situation is very severe. Okay, then they started taking multiple measures. Insolvency and Bankruptcy Code, which came into effect from 2016, is one such measure. What is this Insolvency and Bankruptcy Code? Insolvency Bankruptcy Code is actually a code introduced by the Parliament which came into effect in 2016, which provides a mechanism to reduce the stress faced by any company or to resolve the insolvent situation. What is insolvency? That means if any bank is if any company is defaulted on its payment to any bank, then it is considered as insolvent. So in such cases, a proper mechanism has been introduced by the Insolvency and Bankruptcy Code to enable the bank to resolve their financial stress in a time-bound manner. This Insolvency Bankruptcy Code has enabled the creditors like banks to recover more than 3.5 lakh crores of money from the from the companies. We'll discuss in a separate slide, in the separate topic, how this Insolvency and Bankruptcy Code is going to work and what is the mechanism and how it enabled the banks to recover the loans. Okay, but for the time being, understand that this is also one of the reasons why banks could actually reduce their NPS. Okay, now the other reason is actually prudential framework for resolution of stressed assets. Prudential framework for resolution of stressed asset. This is very important. This is a framework which was actually introduced by the Reserve Bank of India in 2019. And this framework consists of multiple measures that the banks are supposed to take to prevent the NPS and also to address the already existing NPS. Okay, so how do you do it? See, RBI has encouraged banks to recognize the stressed asset at a very early stage. Early recognition. What is this early recognition? See, generally banks consider an asset as a non-performing asset not from the first day of default, but on the 90th day of the default. That means once a asset or once a loan is defaulted, they will wait for 3 months to be declared to declare that asset as a non-performing asset. However, if at all they recognize at a very early stage, right from the very first day, then they can prevent that asset from being slipped into the non-performing asset. That means you can actually prevent a stressed asset or a defaulted asset from being a non-performing asset if timely intervention is actually taken within the first 90 days. Isn't it? So until 2019, only non-performing assets are taken seriously, but from 2019, under this prudential framework of resolution of stressed assets, banks are mandated to categorize the default from the very first day, and these accounts are known as special mentioned accounts, SMAs, special mentioned accounts. Special mentioned accounts are those accounts which have been defaulted and yet to become non-performing assets. That means whose duration of the default is less than 90 days. Okay. It has 3 categories like SMA 0, 1, 2. Depending upon the duration, they are actually categorized into different categories. SMA 0 refers to, special mentioned account 0 refers to those accounts which have been defaulted for a duration of 1 to 30 days. SMA 1 refers to those accounts which have been defaulted for a duration of 30 to 60 days, and SMA 2 refers to the category of assets which have been defaulted for a duration of more than 60 days but yet to become NPA. That means the duration is somewhere between 60 to 90 days. So if at all the banks start categorizing them into small, special mentioned accounts before they become non-performing asset, then they can take timely intervention to prevent them from becoming non-performing asset. So this is mandated by prudential framework for resolution of the stressed asset by the bank. Okay, there are other steps which are also mandated by this. Is after early recognition is done, mandatory reporting is actually mandated. Mandatory reporting is the second aspect of this framework. That means once a bank finds a default, then it has to update it with a repository known as Central Repository of Information on Large Credit. Central Repository of Information on Large Credit is a database maintained by the Reserve Bank of India with respect to all the large credits. What is a large credit? Large credit is a loan given by a bank whose size is more than 5 crore. If the loan size is more than 5 crore, it is considered as large credit. So every information about this large credit needs to be updated by the respective bank in this database which is maintained by the RBI. And this database is actually distributed, made accessible to all other banks as well. So whenever if any bank faces any particular default with respect to the large credit, it has to immediately update on a weekly basis to this repository. Then it can actually send a signal to the other banks who are thinking of giving loan to the same customer. Then they can cross check whether the particular customer has been paying the loan regularly to the existing bank or not. He can cross check with this, the particular bank can actually cross check that through this database. So this is mandatory reporting. So this prevents further NPS. So this prudential framework for resolution of the stressed asset has created a framework which enabled the banks to prevent the NPS and also resolve the NPS. How do they resolve NPS? One thing, they can actually go to the insolvency and bankruptcy code. That means they can take the advantage of insolvency and bankruptcy code. Or there is another way, before going to the insolvency and bankruptcy, these banks can actually negotiate with the debtor, the one who has defaulted on his payment, and make a resolution plan informally, and that resolution plan can be implemented. If at all that is not done within a timely manner, then they have to go to the insolvency and bankruptcy code. That was actually mandated by Prudential Framework of Resolution for Stressed Asset. And this exercise has greatly influenced the banking sector and greatly, improved the health of the banking sector in the last 5 to 6 years. And the manifestation is clearly seen in declining the gross NPA ratio of the total scheduled commercial banks in Indian economy. And the last reason is actually NARCL, Establishment of National Asset Reconstruction Company Limited. Asset Reconstruction Company Limited. Okay, what is Asset Reconstruction Company? It's a bad bank. Colloquially, it is known as a bad bank. That means a bank which acquires the toxic assets and non-performing assets of the bank and revive them separately. So when a bank is actually given to an NARCL, that means when a bank gives its loan to NARCL, then it gets rid of this loan completely. So NARCL has acquired bad assets from the banks to the tune of $1 trillion by financial year 2024. 1 trillion rupees, 1 trillion rupees of loans have been acquired, toxic loans have been acquired by NARCL. NARCL is actually a big bad bank which was established with a joint ownership of all the public sector banks. All the public sector banks own more than 51% of the NARCL. Okay, so it's a separate asset reconstruction company, and this is also one of the reasons why the banks could get rid of their NPS. So these are all the reasons why we have seen this significant reduction in the gross NPS of the scheduled commercial banks. Okay, though it is measured, predominantly a prelims topic where you can easily expect questions on net NPA, gross NPA, provisioning coverage ratio, loan write-off, and all these things. But You cannot rule out a mains question on this topic. If at all there is a question which asks you to cite the reasons for improvement health of the banking sector, please do mention all these reasons in your answers. Okay. Now, let us go to the next parameter. Before going to the next parameter, let's solve these two questions. Okay. Question number 9. Which of the following best describes special mentioned account in the bank? We have already discussed what is a special mentioned bank account. See, statement A, an account that do not show any financial stress. No. These are known as standard assets. An account that receives high deposit interest from the banks. No. An account that shows signs of turning into a non-performing asset in the first 90 days. Right. That means any asset which has been defaulted but yet to become a non-performing asset. That means the duration of the default is less than 90 days. Such assets are actually known as special mentioned accounts. Such accounts are known as special mentioned accounts, and this is a very one way of early detection of non-performing assets. Okay. Now question number 10. Which among the following is correct about provisioning requirement of various assets held by a bank? Okay. Standard assets do not require any provisioning. No. Even standard assets require 0.25 to 0.4% of the provisioning requirement. Okay. Loss assets require 100% of the provisioning. Right. As you have seen in the provisioning coverage table, loss assets require 100% of the provisioning amount. Okay. Banks are mandated to maintain the provisioning amount even after the loan is actually written off. No. Once the loan is written off from the balance sheet, there is no need of keeping the provisioning amount. Okay. So answer is A. Sorry. Answer is B. 2 only. Okay. Now we have discussed that the health of the banking sector is measured by two parameters. One is the gross NPA and second is capital adequacy. Okay. See, the normal business of the bank is something like this. They receive the deposits and they give loans to the customers. For the deposits, they pay interest rate on the deposits, and for the loans, they charge interest rate. And the difference between the interest rate that they charge on the loan and the interest rate that they pay on the deposits is net interest margin. That is their profit. However, a bank cannot solely or entirely depend upon the deposits for the lending activities, because there might be an issue of loan default because the assets are riskier. The loans are riskier. So in that case, they may not pay adequate, they may not pay interest rate, or they may not pay interest rate on the deposits. So that is why banks are supposed to maintain a capital by themselves instead of depending upon the deposits completely. So that is why capital is required. But the question is, how much of the capital is required? How much of capital should be maintained by a bank? That is determined by this formula, that is capital adequacy ratio. The amount of the capital that should be maintained by a bank depends upon its credit exposure. That means how riskier the credit is actually. How riskier the loans given by a bank, that determines the amount of the capital that the bank has to keep aside. Okay. So capital adequacy ratio is actually the total capital should be a percentage of total risk weight assets. A percentage of the total risk weight asset. So what is exactly risk weight asset? That means each and every loan given by a bank is associated with multiple kinds of risks. A market risk, or credit risk, operational risk, default risk. There are multiple kinds of risks. So that is why each and every asset, that means each and every loan given by a bank is associated with a risk weightage. Depending upon the nature of the loan, different amount of risk weightage is actually given to that by the Reserve Bank of India. Let's say government securities. Let's say if the bank has invested in the government securities, it is associated with 0% of risk weightage. That means government securities do not carry any risk. What is a government security? It is indirectly a loan given to the government, isn't it? It is a debt instrument issued by the government. So there is an underlying presumption that government would never default. So that is why the risk weight attached to a government security is always 0%. So no matter how much of the money invested by a bank, the risk weightage is always 0%. So let us take an example. Let us say if a bank has invested 2000 crores of rupees in government securities and the risk weightage given to the government security is 0%. So the risk weight adjusted asset is 0. That means risk weight is actually multiplied to this asset value. Then it becomes 0. However, if it is a credit card loan, let's say a bank has given 1000 crores of credit card loans, but for credit card loans, the risk weightage is actually 125%. The risk is very high for credit card loans because credit card loans are consumer loans which are unsecured loans actually. These loans are not given based on a collateral. So the risk is very high. So that is why the risk weightage given to the credit card loans is 125%. So the risk weight adjusted asset is actually 1250 crores. That means it is multiplied by 125%. So 125% of this asset value is the risk weight asset value, which is 1250 crores. Let us take the education loan. For education loan, the risk weightage is actually 100%. That means if a bank has given 5000 crores of loan at risk weightage of 100%, that means 100% of the asset value is risk weight asset. That means 5000 crores. Okay. Let's take the case of housing loan where the risk weightage is actually relatively lesser compared to the other kinds of loans. The risk weightage is only 75%. That means 75% of the total asset value is risk weighted as adjusted value. That means if 7,000 crores of loan has been extended by a bank, 75% of 7,000, which is 5,250 crores. That is the risk weight adjusted asset value. So this total risk weight adjusted asset value should be calculated, and out of it 9% of the amount should be kept as capital. So 9% of total risk weight asset is to be kept as maintained as capital by the bank. So RBI has fixed 9% capital adequacy ratio of 9% for all the scheduled commercial banks. But for exclusively for public sector banks, this is 12%. For public sector banks, this is 12% because for greater health of the banks, Reserve Bank of India has mandated these public sector banks to maintain 12% of the capital. Okay. So now look at this trend of the capital adequacy that was mentioned by the economic survey. It says that the capital adequacy has increased to almost 16 to 17% in the last 2 financial years. Over the last 9 to 10 financial years, the capital adequacy, capital ratio increased from 12 to 16%. That means it shows that banks are maintaining huge capital, and the capital maintained by the bank is way above the required norms. It is well above the required norm. And with larger capital, banks have the leverage to improve their credit exposure. That means banks lending capacity has increased. So this is also one of the parameter which measures the performance of a banking sector. Okay. So there is one more thing that has been discussed, that even though the health of the banking sector has improved based on the measurements that we have discussed already, that GNPA ratio increased and also capital adequacy also increased, which is a good sign. But RBI has actually noticed a specific trend in the banking sector in the last 3 to 4 financial years, and which made it little bit cautious. That is rise in the unsecured lending. What is this rise in unsecured lending? See, with the advent of these credit card loans, nowadays all the banks are readily giving loans to the readily giving credit cards to the consumers. Okay, consumer credit. That means people are using credit card for consuming electronic goods, mobile phones, laptops, and all these things, even for shopping even for the shopping purpose. Okay, now this has increased of late with the advent of this digital lending apps and all these things. And most of these credit card loans are actually unsecured loans. That means there is no collateral to it. Secured loans are actually those loans which are given by the bank based on a collateral, but for these credit card loans there is no collateral. So as we have seen in the first slide that almost 34% of loans are actually given in the personal loan category, especially the credit card loans are booming right now, which is a cause of caution to the cause of concern to the banking sector. What if they start defaulting on these payments? Then it may lead to the banking instability. So that is why RBI wanted to discourage this activity, and to discourage this activity, for all the consumer loans given by the banks, the risk weightage has been increased by 25 basis points. That means earlier for credit card loans, the risk weightage is actually 100%, but it increased to 125% right now. If risk weightage is increased, banks have to keep extra capital. So that is why it may discourage the banks to give too much of credit card loans. So this is one way of discouraging the banks to reduce their unsecured lending. That is one aspect that has been noticed by the Reserve Bank of India. And second is increasing credit exposure to NBFCs. Increasing credit exposure to NBFCs. Now, you must be wondering, why is it a cause of concern to the RBI? What's wrong in giving credit to the NBFCs? In fact, NBFCs have strong presence in the grassroots level. So there is a saying which says that NBFC starts where bank stops. So often banks have to rely upon the NBFCs to disburse their credit through NBFCs. Okay, this is a good exercise. This is a healthy partnership between banks and NBFCs, but there is a cause of concern. There is a catch to it. Most of the NBFCs in India, non-banking financial companies in India, they do not run on a large capital. They heavily depend upon the loans given by the banks, which they themselves give it to loans to the other customers. So they often face liquidity crisis due to asset liability mismatch. Liquidity crisis due to asset liability mismatch. What is this asset liability mismatch? Asset liability mismatch refers to a situation where a bank receives deposits, short-term deposits, but it gives long-term loans. When bank receives short-term deposits but extends long-term loans, then it leads to asset liability mismatch, because it takes a lot of time for the maturity of the loan is much higher than the maturity of the deposit. So they have to meet the redemption requirements of the deposits. They may face default. For example, if an NBFC has taken loan from a bank and it has given loan to an infrastructure project, and the bank has to receive the payment in time, but NBFC is not able to pay it in time because NBFC is yet to receive the payment from these infrastructure projects. This asset liability mismatch often results in liquidity crisis. So it may lead to the interconnected risk. Interconnected risk means any instability in the NBFC sector, or any crisis in the NBFC sector will be contagious to the banking sector. And that is why RBI has been very cautious of increasing credit exposure of the banks to the NBFCs. And that is why, just like how the RBI wanted to reduce the unsecured lending practices by the banks, it also wants to reduce this increasing credit exposure to the NBFCs. And hence, bank loans given to the NBFCs is associated with a certain amount of risk, and the risk has been increased by 25 basis points. Earlier the risk was actually around 75% to 100% for different kind of loans. Now it increased by 25%. That means it increased from 100 to 125%. So these are the two aspects again which is very much relevant in the last 2 financial year with respect to the banking sector, which RBI has actually taken note of. Okay. So this is with respect to the capital and risk weight assets. Okay. So let's solve a question on this, a basic question. Question number 11. Look at the question. Which of the following statements about risk weight asset calculations in India is correct? First statement. Investments in government securities do not carry any risk. Correct. Because government securities are considered as gilt-edged securities, are those securities which do not have any risk weightage, where the risk weightage is actually 0%. That means the underlying presumption is that a government would never default. Okay. So any investment made by the bank do not carry in the government security do not carry any amount of risk. Look at the second statement. Risk weight asset cannot be more than the value of the asset. Read the statement again. Risk weight asset cannot be more than the value of the asset. No, it can be. If the risk weightage is 125%, that means risk weightage asset is actually 125% of the original asset value. So this is, in this case, let's take the case of credit card loan. The original asset value is actually 100,000 crores. Since the risk weightage is actually 125%, the risk weight asset is actually 1,250 crores. So the second statement is actually wrong. Risk weight asset or risk weight adjusted asset can be more than the original asset value. Okay. So the first statement is actually right. Only the first statement is right. Okay. Now, the other aspect of the banking sector. Let us look into the other aspect of the banking sector, which is the trends in the credit disbursal by the banking sector in India. So in the previous discussion, previous slides, we have discussed that how we have witnessed improvement in the health of the banking sector, isn't it? So when the health of the banking sector increases, let's say in the form of reducing NPAs or in the form of accumulation of more capital, that should be automatically reflected in increasing credit dispersal by the banks, isn't it? So how much of credit is actually disbursed by the banking sector in India, and what is its impact on the overall GDP? That is actually measured in terms of credit to GDP ratio. Okay, so to understand what is credit to GDP ratio and what is its significance and how is it different from credit to GDP gap, you need to understand the significance of the credit and how credit is actually significant to the GDP. First of all, let's briefly understand how banking credit is actually going to have an impact on the output of the economy. When the bank starts giving credit, it will actually have an impact on the overall investment and consumption in the market. That means the credit is actually disbursed by a bank to any entity, either a business or an individual. Okay, if a business or if a company borrows loan from the bank, okay, borrows money from the bank, then they're going to use that money for any investment purpose, or if it is taken by any individual for any consumption purpose, just like credit card, then they will start purchasing goods and services in the market. So in either case, it is going to increase the aggregate demand in the market. Either increasing investment or increasing consumption is going to improve the aggregate demand, enhance the aggregate demand in the market, and this will eventually increase the overall output in the economy, which is measured in GDP. What is GDP? The total output produced in an economy. So credit is important for the GDP of an economy. So that is why when we say that if India wants to achieve the target of $5 trillion economy, then it cannot be done without increasing the banking credit. And that is why banking credit is all the more important for economy in the following decade. Okay. And this is actually a positive loop mechanism where increasing output will also have an increasing in the overall credit disbursal by the banking sector, because increasing output may increase the employment opportunities, and with increasing employment the disposable income increases, and the propensity of the people to save in the banks is going to be increased, which will increase the lending capacity of the banks and thereby increasing the credit disbursal by the banking sector. Or let's say if increasing output is resulted in if it is seen in the increasing profits of the banking sector, so profits of the companies, when the company is in a good shape thanks to the increasing GDP, if the companies or business are in good shape, then they are going to pay back their loans, both the principal and interest amount, on time without any default. So which will increase the profitability of the banking sector, so that if the profitability of the banking sector is improved, the credit disbursal or the lending capacity will be increased, which is reflected in the increasing credit disbursal by the banking sector. So it is actually a positive loop or a positive feedback mechanism where credit will eventually increase the GDP and GDP will eventually increase the credit mechanism. So as I said, if India wants to achieve the target of becoming a $5 trillion economy, the key lies in improving the banking credit. So the availability of the credit to improve the output of an economy is measured by a measurement known as credit to GDP ratio. Credit to GDP ratio. What is credit to GDP ratio? The total credit given by the total credit disbursed or credit given by banks and other financial institutions. It's not just the banks, NBFCs, microfinancial institutions, or any, for example, if you're investing in a bond, that is also considered as a credit because that is a debt instrument. So the total credit given in the economy by the total output, that means GDP. So this is known as credit to GDP ratio. And in India, the credit to GDP ratio is around 99% in the financial year 23-24. In fact, it has improved in the last 2 years, in the last 3 years. From the financial year 21 to 24, there has been significant improvement. In the financial year 21, the credit to GDP ratio is actually 88%. Now it has been improved to 98%. That means the credit increased, the credit delivery increased, because the numerator is actually the credit. So if the credit GDP ratio is increasing, which means the credit delivery is actually improving. Okay, the growth in the credit is actually very good. Okay, see, in fact, the credit to GDP ratio in India is actually always hovers between 90 to 100%. Right now it is around 98 to 99%. Okay, which is close to 100%. If you compare this to other advanced economies, where the credit to GDP ratio is much higher. Credit to GDP ratio in India is actually, let's say if it is around 100%, but in most of the advanced economies, it is more than 100%. That means 120%, 150% in advanced economies like USA, UK, Japan and Germany. In fact, in countries like China, the credit to GDP ratio, it is very surprising that, to see that credit to GDP ratio in China almost touched 180 to 200%. Now you must be wondering, why is this credit is much higher than the GDP? How come credit to GDP ratio can be more than 100%? Which means, let's say if what do you mean by more than 100% credit to GDP ratio? Let's say if an economy is of size of $5 trillion economy, which means its GDP is 5 trillion, does it mean the credit is actually more than the 5 trillion? Let's say 6 trillion or $7 trillion credit is given, but it is producing only $5 trillion economy or $5 trillion output. Does it mean the credit, whatever that is being given in the economy, is it being used unproductively without having a significant impact on the GDP? Does it mean that? No. Credit to GDP ratio of more than 100% may not mean that the credit is actually being utilized for unproductive purpose without having any impact on the GDP. No, that is not the reason. In fact, in most of the advanced economies, credit to GDP ratio is actually more than 100% and it is actually a good sign. Let me explain you how. Most of the times, the bank credit given in the credit given in the economy in that particular financial year takes time to be reflected in the increasing output. Let's say if a bank has given certain amount of money to certain amount of loan to an infrastructure project. Let's say 10,000 crores of loans have been given to the infrastructure project. So the loan disbursed in that particular financial year is actually mentioned in the credit given, but for the infrastructure project to be completed, it may take 5 years or 10 years. So until and unless the entire infrastructure project is actually completed, it is not recorded in the GDP. So that is why often it seems that the credit to GDP ratio is more than 100%, but it doesn't mean that the increasing credit is actually being unproductively utilized. It is being utilized, but it takes time to be reflected in the GDP. So whatever the credit given by the banking sector in the economy is going to be reflected in the GDP of the coming years. It is not necessarily it should be reflected in the same year. It may be reflected in the coming years and down the line. So that is why in most of the countries and most of the advanced economies, the credit to GDP ratio is more than 100%. Okay. Now, why is it so high in these advanced economies compared to India? And why is it credit to GDP ratio cannot be more than 100%, and why we could not push it beyond 100% in most of the years? Okay. The reason is simple because in the advanced economies, the penetration of the banking sector is very huge. The degree of the penetration and the degree of the financial inclusion is very good. Unlike in India, where access to the institutional credit is still a very, difficult process. So the availability of the credit is very easier in these advanced economies compared to India. So that is one of the reasons and foremost reasons why the credit to GDP ratio is more or less hovers around 100% in India. Okay. And not only that, you need to understand why the credit to GDP ratio is below 100% in India is that it is something to do with the nature of the economy. Let me tell you, it's pretty interesting that in India's economy, if you see, the sectoral contribution towards the GDP is slightly imbalanced. That means look at the agriculture sector. The agriculture sector contribution to the GDP is hardly 20%, not even 20% in fact, below 20%. Even if you give credit to the agriculture sector due to certain issues, due to land fragmentation and due to other issues, decreasing productivity, it cannot significantly improve the GDP of the agriculture sector. The same thing happens in the manufacturing sector. Due to inadequate, due to lack of ease of doing business or other policy barriers, or due to lack of demand, or due to infrastructure bottlenecks, or due to inadequate supply of cheaper labor, inadequate supply of skilled labor, even if you increase the credit to the in manufacturing sector, they cannot use it for the productive purpose. So there is no genuine demand in the credit from certain sectors in the Indian economy. The most of the credit is actually given to infrastructure, service sector and other consumption sectors. Most of the businesses are actually, they are not demanding too much of credit. That means the potential of the economy is so limited that it is not, the potential demand of the credit is actually relatively lesser in Indian economy compared to the other advanced economies. There is the potential of the economy can absorb too much of credit because there is too much of demand in their economy, because there are no barriers. There is no barrier to the ease of doing business. There are no infrastructural bottlenecks and there are no shortage of skilled labor force in those economies, and that is why they can take more demand and they can absorb more demand. These economies can absorb more credit into their economies, which is not the case in India's case. So that is why in India, credit to GDP ratio is relatively lesser because our potential of the economy is relatively lesser. So that is why the credit is actually less. Right. Now, it boils down to the argument that whether credit to GDP ratio, whether the credit that is available in our economy, is it meeting the potential demand of the economy or not? Is it meeting the potential demand of the economy or not? That is actually measured in credit to GDP gap. It cannot be simply measured in credit to GDP ratio. It cannot be measured in credit to GDP ratio. Let's say, for example, if at all 20%, if at all, let's say $3 trillion rupees of money is actually $3 trillion of credit is given in the economy, and it has resulted in $3 trillion of output, then we say that credit to GDP ratio is actually 100%. But it cannot explain you whether there is extra demand for the credit or not. Probably if more credit is available, probably there would have been more GDP or not. You never know. So whether the credit delivered is adequately meeting the demand of the potential of the economy or not is measured through credit to GDP gap. This is an innovative measurement which measures the right availability of the credit in the economy. Okay, so credit to GDP gap is a difference between the current credit to GDP ratio to its long-term trend. That means that the difference between this year's credit to GDP ratio to its long-term trend or long-term average. Let me explain this through an example. Let's say in this particular financial year, the credit to GDP ratio is, let's say, 95%. Okay. And the long-term trend in the last 10 to 20 years is actually, long-term average is 100%. That means the credit to GDP ratio, the credit to GDP gap is actually minus 5%. On the other hand, let us say in another example, if the credit to GDP ratio in this particular financial year is, let's say, 95%, and let's assume that if the long-term trend of the last 10 to 20 years is actually 90%, then the gap is actually plus 5%. That means this year credit to GDP ratio is higher than the long-term average. Okay. So which means credit to GDP ratio, credit to GDP gap is actually can be either negative or positive. Either negative or positive. Okay. Now what does it mean? When credit to GDP gap is actually negative, which means this year credit to GDP ratio is less than its long-term trend. Less than long-term trend. That means there is a scope for the economy to improve its credit, thereby improving its GDP. That means there is a potential in the economy to improve its GDP, but it is not being able to improve its GDP because there is no credit availability in the economy. So if credit availability is going to be increased, it will definitely increase the GDP of the economy. That means there is underutilization of the financial resources in this case. Underutilization of financial resources. So this is actually due to this underutilization of the financial resources, the economy is actually sluggish. That means economy is lagging behind its potential GDP. Right. On the other hand, the credit to GDP gap can be positive. The credit GDP gap can be positive, which means that the present year's credit to GDP ratio is higher than its long-term average or long-term trend. So how can it be higher than the long-term trend? Which means the credit is actually growing faster than the GDP growth rate. That means if GDP is growing at 10%, credit is actually growing at 20%. Then that means there is surplus availability of the credit beyond the need of the economy. There is surplus availability of the credit beyond the need of the economy, beyond the potential of the economy. In that case, the surplus credit may lead to asset bubble. That means banks are actually easily providing the loans without any due diligence, and this may lead to asset bubble. That means people take loan from the banks for a cheaper cost because there is easier availability of the credit, and they will start investing in certain assets like gold and real estate, which will eventually inflate the prices of these assets. And this inflated price or inflated bubble is going to be burst because it is not backed by any genuine demand. The inflation of these assets is only because of the cheaper availability of the credit. In fact, this is what happened in the US in 2008. The global financial crisis started with this asset bubble because there was easier availability of the credit. The availability of the credit in the economy was much more than the demand of the economy. So it is much more than the potential GDP of the economy. So the credit growth rate is very significantly way higher than the GDP growth rate. So we can infer from this that neither positive nor negative credit to GDP gap is desirable. If it is negative, the economy is running behind its potential GDP. There is a possibility or scope for the economy to improve its credit availability and hence improve the potential GDP, improve the GDP of the economy. If it is positive, the credit availability is more than the requirement of the economy, which may lead to asset bubble and which may lead to financial instability. So the idea is to keep the credit to GDP gap to zero, as closer as possible to zero. That means always keep your credit to GDP ratio close to your long-term trend. That's it. So what happened? Why are we discussing this credit to GDP gap? Because this is specifically mentioned in the economic survey. This is actually directly picked from the economic survey. Look at the credit to GDP gap trend in the last 20 years and you will see a very interesting trend here. See, credit to GDP gap in the first decade of this century, let's say from almost 2003 to 2012, here we have seen positive gap. That means the credit to GDP ratio is higher than the long-term average. And that means credit is growing faster than the GDP. It even went to that extent, the gap has been almost 20% in certain years. That means banks have started extending credit to anybody and everybody without any due diligence. This is not a good sign. This wasn't a good sign. So obviously the economy had seen its negative consequences. By the time of by 2012 or 2013, Indian banks are at their worst situation, because all the loans that they have given turned out to be non-performing assets, because whichever companies have taken the cheaper loans, they invested, but there is no demand in the economy. There is no demand in the economy. So that is why this has resulted in banking crisis after 2012, and that is clearly reflected in negative gap following decade. A negative gap following decade. That means even though there was a demand in the economy after 2012, after 2013, the banks were not able to provide the credit because they were already reeling under the pressure of accumulated NPAs because of this in the previous decade. So we have seen negative gap for almost 10 years till 2021. Now, thankfully, in the last 3 years, we have seen that that the negative gap has been narrowed down. Now, in the financial year 2024, it almost reached zero. That means it touched its long-term average or long-term trend. Thankfully. So this is a good sign. That means right now the credit that is being available in the economy, Indian economy, is optimally meeting the demand of the economy. It is neither more nor lesser than it. Okay. So this is what the credit to GDP gap is all about. Okay. So this is what mentioned in the economic survey. So we can expect a question on this exact term. What is exactly the credit to GDP? Okay. Look at the question. Consider the following statements about credit to GDP gap. Credit to GDP gap. Okay. Look at the first statement. It is an economic indicator that measures the difference between total credit extended by banks and financial institutions and total GDP of an economy in a financial year. Read the statement again. Here the statement is saying that credit to GDP gap is an economic indicator which measures the difference between the credit disbursed by the financial institutions and the total GDP of the economy, which is wrong. It is not a literal difference between the credit and GDP. It is a difference between the credit to GDP ratios. What is the current financial year credit to GDP ratio, and what is its long-term average? That is what the credit GDP gap. Okay. The next, positive gap indicates a potential financial instability, whereas negative gap indicates a sluggish economy. Right? Positive gap indicates a potential financial instability. Positive gap means this year credit to GDP ratio is higher than its long-term average, which means credit is growing faster than the GDP growth rate. That means surplus credit is available beyond the requirement of the economy. Then it may lead to the asset bubble and it may lead to the potential financial instability. Whereas negative gap indicates a sluggish economy, which means there is a possibility GDP is growing faster, but credit is actually not growing faster enough. So there is a possibility for the credit to be increased to meet the potential GDP. So the second statement is right. So answer is 2 only, B. So this is about the credit to GDP gap report. Now, the next topic is corporate insolvency resolution process under Insolvency and Bankruptcy Code. See, in the previous example, in the previous slides, we have discussed about how the credit availability increased in India. Okay, thanks to the improving health of the banking sector. Okay, with increasing credit availability, you know what happens? The credit exposure, with increasing credit exposure, the risk of the default is also going to be increased. The risk of the default is also going to be increased. So if the risk of the default is going to be increased, banks have only 2 options. One, either to write off the loan, which is an extreme step, which is completely an extreme step, and banks will resort to writing off a loan only in the case of only when all other options are actually exhausted. The best way of dealing with this kind of default is to help the company or help the debtor to revive his business, and make him pay the dues at a later date. So this is known as resolution of the stressed asset. This is known as resolution of stressed asset. So Insolvency and Bankruptcy Code has provided a robust mechanism enabling the banks to resolve their stressed asset at one point, and also enabling the companies or the debtor companies which have been defaulted to revive their business if there is a chance, and if nothing works out, it will give them an honorable exit from the business. Okay, so let's see how and why does it happen. Okay, so why are we discussing about this IBC? Because this is the excerpt that I have taken from the economic survey, which has specifically mentioned separate section about efficacy of the insolvency law. Efficacy of the insolvency law. Okay, first of all, let's discuss what is the mechanism of insolvency and bankruptcy code, and then we'll discuss what is its efficacy and what are its limitations. Okay, first and foremost, whenever a company which receives loan from a particular bank, when it's defaulted, then that particular company is considered as insolvent. That particular company is considered as insolvent. When the insolvency is actually legally recognized through a process like this, then it is considered that the company is bankrupt. The company is bankrupt. So the net effect is same, but the legal recognition changes the name from insolvent to bankrupt. Okay. Now, when a company becomes bankrupt, or company is default on its payment, the creditor, that means bank, financial institution, any other financial institution, or any other creditor who have given loan to the particular company, can file a resolution application under Insolvency and Bankruptcy Code. Okay, so who can file the application? The creditor can file the application. When he can file the application? When the amount of default should be at least 1 crore. When the amount of default should be at least 1 crore, then the creditor can file an application for the resolution. In fact, it's not just the creditor. Let's say a bank has given loan to a company and the company has been defaulted. So now the asset has become non-performing asset. Now what happened? The bank has an option of selling this asset to an asset reconstruction company and get rid of this non-performing asset. Of course, banks have to go for a certain amount of high haircut. Even after going through a haircut, they would want to clean their balance sheet by selling these assets to an asset reconstruction company. Let us assume that an asset reconstruction company has acquired the loan. What does it mean by acquiring the loan? That means the company, when the bank has sold the loan to a particular asset reconstruction company, all the legal rights of recovery will be transferred to the asset reconstruction company. Now it is the responsibility of the ARC to recover the loan. So it is not just the creditor, but also the ARC has the right to file a resolution application under Insolvency and Bankruptcy Code. So asset reconstruction companies can also file resolution application under this Insolvency and Bankruptcy Code. Right? Apart from this too, see, we are talking about the creditors. That means who have given loan to a particular company, but the company has defaulted on its payment. But there are other stakeholders in the company where the default situation may occur. They are employees. If the company has been defaulted on the payment of salaries to the employees, then that is also a default. Then they can also go to the company, they can also file an application provided the defaulted amount is actually 1 crore. Provided the defaulted amount is actually 1 crore, they can also file resolution application under Insolvency and Bankruptcy Code framework. So who can file the application? Creditor, ARC, employees. And surprisingly, IBC framework has also enabled the debtor himself to file for resolution application. Debtor himself can file the resolution application. That means the company who defaulted on the payment to a particular bank, they themselves can go to the NCLT and file a resolution application under this IBC framework. And why would they do that? We'll see why would they do that. Okay. So these are the conditions of application. Okay. Once an application is actually submitted, the application is actually submitted to NCLT, National Companies Law Tribunal, if it is a corporate insolvency. See, we are discussing about only corporate insolvency resolution here. We are not discussing about individual insolvency. In fact, IBC framework given mechanism to resolve both individual and corporate insolvency, but we are sticking to only corporate insolvency. If it is a corporate insolvency, the adjudicating authority is actually National Companies Law Tribunal, whereas if it is an individual default, the adjudicating authority is actually Debt Recovery Tribunal. So we are not discussing the individual insolvency, so let's stick to the corporate insolvency. If it is a corporate insolvency, no matter who the stakeholder is, no matter who the applicant is, the applicant has to submit the resolution application to adjudicating authority, which is National Companies Law Tribunal. And this NCLT will either accept or reject the application, but it must be done within 14 days. That means within 2 weeks, the NCLT will give its will give its decision on the application. So if the application is actually rejected, when do you think the application is rejected? Let's say sometimes when the application says that the amount of the default is 1 crore, but when the company NCLT finds out that an amount of default is less than 1 crore, so then it can actually reject the application. So the NCLT will cross verify the claims made by the applicant. For that, they take at least 14 days. So when they find any miscalculations in the application and they actually reject the application, once it is rejected, that is the end of the story. Now what happens if it is accepted? After cross verifying the claims made by the applicant saying that this much of amount has been defaulted by this particular debtor, so now I am applying for resolution of my stressed assets, resolution under this IBC framework. Okay, then NCLT finds verifies it, and if it is accepted, the first and foremost process that is kick-started is actually the moratorium. A moratorium is actually imposed on the debtor company. What exactly is this moratorium? This moratorium is actually, it's a legal protection given to the debtor from any other law in force at that particular time during the process of insolvency resolution. That means once an applicant has actually filed for resolution process, now it is under the control of NCLT. Once it is accepted, now it is under the framework of IBC framework. So nobody can actually confiscate the assets of this debtor company without completing the entire procedure. So this legal protection is actually given to the debtor company from the confiscation of assets. Okay, so that is what exactly moratorium is all about. During the moratorium phase, the company cannot sell its assets without approval of NCLT. Nothing can be done. Okay, so that kind of legal protection is actually given. And the next step is actually appointment of insolvency professional. NCLT is going to appoint a particular professional known as insolvency professional to take care of this entire resolution process. Okay. Now this insolvency professional will start taking control of the management of the debtor company. Now the management is taken under the control of the insolvency professional, not with the debtor company. So this is what the significance of this IBC framework. Since moratorium is imposed, nothing can be done without the approval of the creditor, or nothing can be done without the approval of NCLT. Okay. Now what is the role of this insolvency professional? The insolvency professional is going to enable the process of insolvency resolution. That means he will actually constitute a committee of the creditors. That means all the creditors come together and they make a committee, a group. That committee of creditors, this insolvency professional is going to discuss with the committee of the creditors with respect to how the insolvency can be resolved. What could be done with the debtor company so that these creditors can receive their payments again. They can recover their dues again. So then they come up with a resolution plan. This is the first step. Resolution plan in the resolution. This is the first step in the resolution process. A resolution plan is actually made. Now you must be wondering what exactly is resolution plan. So what can be done here? The resolution plan is actually, let's say, improve debt restructuring. What is debt restructuring? Debt restructuring is actually changing the maturity of the debt. That means if the loan has to be paid back in 10 years, they will extend the period of the loan repayment. So extending the period of loan repayment is one way of debt restructuring. Extension of schedule, or they may reduce the interest rate, reduction of interest, or they may even reduce principal amount, reduce the principal amount, or they may convert the debt into equity. That means if a bank owes 1000 crores, instead of the debt, they would want to keep the debt into equity. That means investing the 1000 crores into the share of that company, and if at all the company runs its business properly, they will start to receive the dividends from the company. So conversion of debt to equity, conversion of debt into equity. So these are different ways by which debt restructuring is actually done. This debt restructuring is going to give a scope or in a space for the company to reduce the debt burden and revive the business again, and it will enable the company to pay back their dues to the bank. And resolution plan also includes selling of certain non-core assets. Selling of assets. What is this non-core assets? That means there's extra buildings, vehicles, other real estate properties, or equipment which are not directly utilized for the core aspects of the business. If it is a manufacturing company and if it has a separate real estate property which has nothing to do with the production of the manufacturing, then they may actually sell that asset and recover the dues. So selling of the non-core asset is also one way of recovering the dues. And changing the management change is also important. If at all they believe that a new CEO or new managing director can be appointed who can actually take care of the business better than themselves, then they can actually change the management as well. So these are the different aspects actually mentioned in the resolution plan. And insolvency professional will help the committee of the creditors to draft this resolution plan, and this resolution plan must be accepted by the committee of the creditors. That means resolution plan cannot be implemented without the approval of the committee of the creditors. Only if it is acceptable to them, only then committee of the creditors can actually accept that resolution plan can be implemented. And this committee of the creditors should accept it by an vote share of 66% or 2/3 vote share. 2/3 voting. 2/3 voting is actually done, and when the committee of the creditors accept the resolution plan, then the resolution plan is going to be implemented. Okay. If at all the committee of the creditors and the insolvency professional could not arrive at a resolution plan within 330 days, it goes to liquidation. Once the corporate insolvency resolution process, this plan is actually accepted, it is implemented. If it cannot be implemented or if it is not accepted within 330 days, then it goes to liquidation. What is liquidation? Liquidation is the last step. That means winding up of the business and selling the entire property and assets of the business, including core and non-core assets, and the creditors will start receiving their payment according to their share. This is the last step. This liquidation gives an honorable exit for the company, where actually there is no hope of recovery through these resolution plans. If at all there is a hope of recovery through these resolution plans, then they will go for this resolution plan. If they believe that there is no hope of recovery, then they will go for liquidation. So accepting or rejecting this resolution plan is completely in the hands of committee of the creditors. So this is the insolvency and bankruptcy, corporate insolvency resolution process under bankruptcy code. I hope you understand. Okay. Now that you understood the mechanism of IBC framework and how corporate insolvency is resolved under IBC framework, let us understand what exactly economic survey has mentioned about the efficacy of insolvency and bankruptcy code. According to the IBC framework, according to the economic survey, the IBC framework has resulted in resolution of many such insolvency companies, and it resulted in recovery of around 3.6 lakh crores of rupees of money by the banks. Okay, this is a good sign. However, economic survey has also talked about the limitations of the insolvency and bankruptcy framework. That means there are certain challenges which are actually preventing the potential uses of this IBC framework. So in this context, let us also discuss the challenges faced by the IBC framework, or challenges with respect to the implementation of the IBC framework. Okay. So the first and foremost challenge is the delays. See, as you have already seen, the IBC framework has given a mechanism for the time-bound resolution of the insolvency. The maximum time period given under IBC framework is 330 days. This is the legal limit of IBC framework. But however, in reality, on an average, the resolution of the cases under IBC took 760 days, which means almost double the duration of the time that has been fixed by the IBC framework. See, time-bound resolution of insolvency is the core principle of IBC framework, and if that is being delayed, then the entire principle or the entire purpose of the IBC framework is defeated. Now let us understand why do we see such huge delays with respect to the resolution of insolvency in IBC under IBC framework. The first and foremost problem is the burden on the NCLTs. As we have seen in the previous slide, that the adjudicating authority with respect to the corporate insolvency under IBC framework is National Companies Law Tribunal. NCLT is given with the entrusted with the responsibility of to oversee the cases, to deal with the IBC cases. But the problem is, NCLT is not a dedicated tribunal exclusively for IBC cases. NCLT also deals with the cases with respect to the mergers and acquisitions and other legal disputes with respect to the Companies Act. So already it is burdened with the other companies related disputes, and the NCLT has very less number of benches and less number of judicial persons and experts in these tribunals to deal with these IBC cases. And this is one of the significant reasons for huge delays with respect to the resolution. And the other challenge is inadequate information utilities. What is information utility? Information utility is an entity or an organization which maintains the database with respect to the financial information of all the companies. The financial information like what is the debt of a company, and what is the collateral that the company has actually submitted to acquire the debt, whether the company has been paying the debt on time or not, and if there is any delay with respect to if there is any default with respect to the debt repayment or not. All this information is actually compiled and managed by these information utilities. In fact, these information utilities are very important for the speedier resolution process. Why? Because see, the first method, the first step of this IBC framework is, once the application is submitted by the creditor, it should be accepted or rejected by the NCLT within 14 days. NCLT will be able to take the decision only when it has required financial information. That means it has to cross verify whether the company has actually defaulted or not, whether it is compulsory for the particular resolution process, insolvent company to be brought under insolvency and bankruptcy code or not. For that, it has to cross verify, it has to access the much needed information from the information utilities. However, we don't have adequate information utilities, and that is the reason even the NCLTs are actually taking more than 2 months or 3 months just to decide upon the application. In fact, in some of the cases, NCLT has taken more than 100 days to accept the application itself. So if it takes 100 days for the acceptance of the application itself, just imagine how much of the time it is going to take with respect to the resolution of the entire insolvent, to complete the entire insolvent resolution process. So this is the problem. Inadequate amount or inadequate availability of information utilities handicap the NCLT functioning. And the other issue is delays in reaching the consensus by the committee of creditors. As we have already seen in the previous slide that the insolvency professional, the first and foremost function of the insolvency professional is to arrive at constitute a committee of creditors and enable and draft a resolution plan which is acceptable to this committee of creditors. The committee of creditors, the committee has to accept the resolution plan through a voting which requires at least 66% of voting. But the problem is, if the committee of creditors comprises of multiple creditors, then it is very difficult to arrive at a consensus. Often the drafted resolution plan fails to get acceptance of this committee of the creditors. Everybody has some problem or the other problem. That means one particular creditor may not like the valuation of the property. The other creditor may not like the resolution plan that that they have already drafted. So this is the reason often there is huge delay in reaching consensus by the committee of the creditors, before which they can actually accept the plan and then start implementation of the resolution plan. And that is why we see this huge delay. And other issue is delays due to litigation. Delays due to litigation. What litigation are we talking about? For example, let's say once the resolution plan is actually accepted by the committee of creditors, now it has got the approval of NCLT and the corporate insolvency resolution plan has been accepted and it has started being implemented. And that is when there are chances of litigation against the plan. In fact, in the entire process, the debtor has no role. The corporate debtor is nowhere involved in the drafting of the resolution plan, and the debtor's actual opinions are not taken into account. And if at all the debtor feels that there is his assets are being confiscated and his management of the control of the management is actually being taken over by the insolvency professional without due diligence, he can actually file a case in the NCLAT or National Companies Law Appellate Tribunal, NCLAT. If the debtor does not get relief at NCLAT, he may even go to the Supreme Court. Then Supreme Court will put a stay on the entire resolution plan, and hence the resolution plan implementation will be delayed. This is what happens in most of the cases. In most of the cases, one or the aggrieved party will go against this resolution plan and start filing a petition in the appellate tribunal, and if they don't get relief in the appellate tribunal, they will go to the Supreme Court. This kind of repeated and frequent litigation acts as a hurdle to the efficient implementation of the resolution plan, and that leads to delays in the resolution process. And the other challenge is shortage of insolvency professionals. See, insolvency professionals play a very significant role in the smooth functioning or the smooth implementation of the entire resolution process under IBC framework. In fact, it is the insolvency professional who is going to take over the entire process, who is going to take over the management, and who sees through the entire implementation of the corporate resolution process. But unfortunately, we don't have adequate availability of insolvency resolution professionals. These insolvency resolution professionals should have proper management and financial knowledge. And in India, we don't have separate dedicated institutions to produce these certified insolvency professionals. In fact, we have seen that there are only just 77 professionals who have been registered in the first half of this fiscal. This inadequate availability of the insolvency professional have definitely impacted the smooth functioning of IBC framework. Right? And the last challenge is the haircuts, large haircuts that the banks have to go through. See, again, coming back to the process, if at all insolvency resolution process or resolution plan is accepted, like debt restructuring or selling of the non-core assets or management change, all these plans are accepted and the plan will be implemented, it's well and good. if at all the plan cannot be accepted in time, or if the plan is actually rejected by the committee of the creditors, then it will go for liquidation, as we have already discussed. But the problem is, due to the huge delays in the implementation of the resolution plan, even if they go for liquidation, that means at the time of the winding up of the business and in the selling the assets, the value of the assets is going to be reduced. And hence, when the company goes for liquidation, the creditors are not able to receive their payments duly. That means they cannot recover their entire payment or entire dues. They hardly recover 20% or 30% of their total dues. And hence, they had to face large haircuts in the entire resolution process. And that is why most of the creditors, despite knowing that this IBC framework is a very good time-bound mechanism, they do not prefer going for IBC framework. They do not prefer approaching this IBC framework because of these large haircuts, because of the fear of large haircuts. In fact, in financial year 2022, out of almost 100 companies have faced 90% of the 90% of haircuts. That means when they went for IBC framework, they have recovered only 10% of their due amount. So these are the issues which are being faced with respect to the implementation of the IBC framework. And hence, Economic Survey has said that if at all, as long as the government is not going to address these challenges, the economy cannot take advantage of the potential benefits of this IBC framework. So NCLT should be, the benches of the NCLT, National Companies Law Tribunal, should be expanded and should be strengthened with adequate expertise and infrastructure. And information utility should be encouraged to be set up. Only then the process is going to be expedited, and that will lead to smooth and seamless implementation of the IBC framework. Okay. So this is about IBC framework, and this is what the Economic Survey has talked about Insolvency and Bankruptcy Code. Okay. And the next, let us solve a question based on this topic. Question number 13. How many of the following statements about the Insolvency and Bankruptcy Code framework in India are correct? Look at the first statement. It applies to both individuals and corporate debtors. Yes, IBC framework is applicable to both individual and also corporate debtors. For individual debtors, the adjudicating authority is Debt Recovery Tribunal. For corporate debtors, the adjudicating authority is actually Corporate Insolvency Resolution Process. The adjudicating authority is NCLT. Okay. Second statement, the resolution plan can be accepted by a vote of 50% of the voting share of the financial creditors. Wrong. The resolution plan must be accepted by at least 66% of the vote, which means 2/3. 2/3 of the voting should be given. Okay. Now, third statement, the NCLT has the power to accept or reject the corporate insolvency resolution process application. Yes, since NCLT is the adjudicating authority, it has the power to either accept or reject. Okay. So, how many statements are right? 2 statements are right. So, answer is B, only 2. The next topic is NaBFID. This year, the Economic Survey has specifically mentioned and talked about the significance of National Bank for Financing Infrastructure Development, which is NaBFID. So let us understand what exactly NaBFID is and its functions, so that you can expect a question on this topic. You can easily answer a question on this topic. NaBFID, National Bank for Financing Infrastructure Development, is a dedicated developmental financial institution that was introduced by the government exclusively for the development of infrastructure sector in India. As we have already seen that in the regular banks may find it difficult to fund the infrastructure projects in India. The reason is simple, because they often face asset liability mismatch issue when they want to fund infrastructure projects, because these infrastructure projects are actually long gestation projects. It takes 5 years or 10 years before they even start commercial operations and start paying their loans, loan dues to the banks. But banks have to pay interest to the deposits. These deposits are actually short-term deposits. So that is why banks are unable to meet the demand of the infrastructure financing in India. Even if the banks somehow overcome this issue of asset liability mismatch, they are not in a position to extend huge investment requirements, huge size of investment that is required for the infrastructure sector in India. For that reason, a separate dedicated developmental financial institution has been introduced by the government. In fact, this NaBFID was given All India Financial Institution status under RBI Act 1934. And hence, it is regulated by Reserve Bank of India, just like any other All India Financial Institution that we have discussed in the first slide. So, what is the ownership of the NaBFID? Who owns this NaBFID? Right now, the central government owns 100% shares of the institution. That means the entire ownership lies with the central government as of now. Of course, the plan is to dilute its stake down the line after 5 years by attracting private investments and foreign investment in this NaBFID. But right now, as of now, central government owns 100% shares of this institution. Okay. Now let us discuss the functions of NaBFID. Since it is a infrastructure developmental finance institution, it provides loans and advances for infrastructure projects in India. Apart from directly lending the infrastructure projects, it will also start refinancing such existing loans. What is this refinancing of existing loan? For example, let's say if a normal bank like SBI has given loan to a particular infrastructure project. Let's say SBI has given 10,000 crores to an airport. But that airport infrastructure project will take at least 10 years to be completed and start operations, before which they make payment to the bank. But SBI cannot wait for 10 years. And hence normal banks like SBI cannot give long-term loans to the infrastructure projects. They can hardly give loans for 4 years or 5 years. So in that case, the NaBFID is going to take over the loan after 4 years or 5 years, so that the bank will come over this or tide over this asset liability mismatch issue. So that is what the refinancing of existing loans mean. Which means by refinancing the existing loans, the NaBFID is actually encouraging normal banks to start lending the infrastructure projects. So the normal banks will also be encouraged to provide loans to the infrastructure projects, because they are assured of taking over such loan by the NaBFID down the line. So this is the other function of NaBFID. And the other function is actually attracting investment from private sector investors. How do you think NaBFID is going to attract private sector investment in the infrastructure sector? Simple. NaBFID is going to launch bonds in the market, infrastructure bonds in the market, thereby mobilizing the resources from both institutional investors and also retail investors like you and me. That means even small ticket investments like retail investors also can participate in the infrastructure sector. So it can actually mobilize large scale of investment from the public. And not only that, it also helps in developing the bond market for infrastructure financing. What do you mean by development of bond market for infrastructure financing? See, normally if NaBFID launches a bond, anybody would want to purchase the bond, because NaBFID is actually a 100% government company. So there is a trust over that company. But on the other hand, let's take an example of an infrastructure company. And if that infrastructure company, a private infrastructure company, launches a bond in the market, there are hardly any takers for that bond, because investors, especially retail investors, would not trust these infrastructure companies, especially those companies whose credit rating is actually very poor. And that is one of the reasons in India, why in India the corporate bond market is actually very shallow, and there is no participation of retail investors in the corporate bond market because of the poor credit rating. So this is one of the reasons why the infrastructure companies are often shortage of the funds. Even though if they want to mobilize the funds from the market, there are hardly any investment or any takers for those bonds. So in this case, NaBFID is going to give certain guarantee to the bonds launched by the corporate companies, infrastructure companies. When NaBFID gives certain credit guarantee to these bonds, the investors, retail investors like you and me, will be interested in purchasing such bonds, because even if the corporate company or the infrastructure company defaults on its payment, NaBFID is going to pay the money. So that kind of credit guarantee is going to encourage the credit guarantee is going to improve or enhance the credit rating of these bonds. So that is how, by developing the bond market, by providing credit guarantee to the bonds launched by the private companies, it is going to attract private investment into the infrastructure financing. So that is what I mean by attracting investment from private sector investors. So apart from launching bonds by itself, it will also encourage other companies to launch bonds by providing credit guarantee. So these are the financial functions undertaken by the NaBFID. Apart from these financial functions, it also discharges some certain developmental functions. What are these developmental functions? It facilitates negotiations with various government authorities for dispute resolution in the field of infrastructure financing. See, infrastructure projects are faced with multiple challenges. They face challenges with respect to land acquisition, environmental clearances, mobilizing the finances from the market, and with respect to disputes with respect to the repayment of the loans. And they have to take approvals from multiple authorities. In fact, NaBFID is going to play a significant role by coordinating with the multiple government and non-governmental authorities and regulatory authorities, and making the entire process seamless for the infrastructure company. So this is another function which is discharged by the NaBFID. And also it provides consultancy services in terms of infrastructure financing. That means if at all there is any infrastructure company who wants to mobilize the resources from the market, then it would provide the expertise and it provide the financial information with respect to the tactics on how to develop or how to mobilize the resources efficiently. So NaBFID is going to discharge multiple functions, both financial and developmental functions, to make sure that infrastructure sector in the country receives adequate financing from the market. And this is the significance of NaBFID, and that is why it is very, very important. And a question on this topic has been pending. Okay. Now, what kind of government support is actually given? As I told you, NaBFID is actually going to launch some bonds. So to encourage more investors to participate and invest in these bonds, government guarantee is actually given. The government can guarantee the bonds, debentures and loans issued by the NaBFID. So these are the important points with respect to the NaBFID. Okay. Let us solve a simple question on this topic and move on to the next topic. Question number 15. Which of the following statements are correct about the National Bank for Financing Infrastructure and Development? NaBFID is regulated by RBI. Right, as I told you, it is an all India financial institution under RBI Act 1934. So hence it is regulated by RBI. The entire shareholding of the institution is currently held by the Government of India. Right. As of now, the entire shareholding is actually held by the Government of India. So both the statements are right. Answer is C, both 1 and 2. Okay. So with this, we are done with the banking sector, and the last topic is capital markets. Okay. Let us see what the economic survey has talked about capital market this year. There are two aspects which are actually the two important aspects which needs to be discussed from this topic. One is corporate bond market and other is mutual funds. Okay. See, look at this excerpt that has been taken directly from the economic survey. The economic survey says that in India, corporate bond market is very shallow. What is a corporate bond? A bond is a debt instrument launched by or issued by any entity. If it is issued by a corporate company or a private company, it is corporate bond. it is similar to the government security, but except the fact that except for the fact that it is actually issued by a corporate company. See, in India generally people prefer government securities over corporate bonds. In fact, there are hardly any takers for these corporate bonds. That is exactly mentioned by the economic survey. So look at this. In India, the corporate bond market is very shallow, which means the size of the corporate bond market is very less, which is around 18% of the GDP, compared to almost 80% in Korea and 36% in China. So now the question is, why there is no participation in the corporate bond market? Why people do not want to invest in the corporate bonds? Why private companies find it difficult to mobilize capital and resources through bonds? So let us look into the reasons that were mentioned by the economic survey. The first and foremost reason is actually the high preference for high rated bonds. See, each and every corporate bond is associated with a credit rating. Depending upon the company which is issuing those bonds, an amount, a certain rating is actually given to it by the credit rating agencies. There are different levels of credit rating: AAA, AA, BBB, BB. In fact, in India, investors hardly only prefer the high rated corporate bonds, but unfortunately most of the companies do not have high credit rating in India. Because of lack of this high credit rating, most of the companies fails to mobilize the resources by issuing bonds in the market. Because of this preference for high rated bonds by the investors. And not only that, the issue is also with respect to the mode of issuance. In India, most of the corporate companies try to issue their bonds in the private placement category. So let me tell you, a corporate company can issue a bond in two methods. One is actually private placement, and other is public issuance. One is private placement and other is public issuance. Public issuance means a company is actually launching its bonds in the stock market with an intention of attracting large pool of investors. Launching on stock market like BSE or NSE, National Stock Exchange, or Bombay Stock Exchange. In fact, this should be the ideal case. But more than 90% of the companies, more than 90% of the corporate companies who have already issued bonds in Indian market, they preferred this private placement route over the public issuance route. Why? Why? Because private placement route is actually quite quicker and cheaper for these companies. See, what exactly is private placement? How is it different from the public issuance? As I told you, if a company wants to choose this public issuance, it would launch its bonds in the stock market so that any participant would come and purchase that bond. But in the private placement, the bonds are given to only certain institutional investors, a private pool of institutional investors and high net worth individuals. It is given to institutional investors. Who are these institutional investors? Like banks, pension funds, mutual funds, and also high net worth individuals, those individuals who have huge amount of capital. So under private placement, they would prefer only these small narrow pool of institutional investors and high net worth individuals, and under this route the corporate company can actually decide the price of the bond, and also it can also decide the yield and also the interest rate on the bond, and it is much quicker and cheaper for them, unlike in the public issuance. Because once a company prefers to launch its bond in the stock exchange, it has to seek multiple approvals from the multiple regulatory authorities, including the SEBI. And not only that, once a bond is actually launched on a public platform like BSE or National Stock Exchange, then it is exposed to the market vulnerability. If the market sentiment is not good, there are no takers for this bond, and hence the bond yield is going to be, going to be very volatile. And that is why they do not want to expose their bonds to the large market and a market vulnerability, and they prefer a certain, small pool of investors. Since more than 90% of the bonds that have been issued by the corporate company have preferred private placement route, there is hardly any retail participation in the corporate bond market in India. Retail investors like you and me are actually devoid of these corporate bonds. And this is also one of the reasons why the corporate bond market size is very less in India. It is hardly 18% when compared to 36% in China or 80% in Japan. And other reasons are policy restrictions imposed on the institutional investors. What are these institutional investors? Institutional investors are like insurance companies, pension funds, mutual funds, etc. These institutional investors, they prefer only high rated bonds. In fact, there are certain restrictions imposed on these insurance companies and pension funds not to invest on any bond whose credit rating is actually less than the AA category. As I told you, credit rating agencies give credit rating to multiple bonds issued by the multiple companies. AAA plus, AAA minus, AA minus, BBB. These are the different degree of ranks. So the restrictions, there are certain restrictions on the insurance companies and pension funds saying that they are not supposed to invest on bonds whose credit rating is actually less than AA. That means a significant chunk of the potential investors are actually devoid of a large bond market in India. So this is also one of the reasons for low penetration of bond market in India, corporate bond market in India. And high preference for government securities. See, there is a reason why there are no takers for government corporate bonds, because most of the banks, insurance companies, pension funds, and even institutional investors prefer government securities over corporate bonds. Why is that? Government securities are actually risk-free securities, because the underlying assumption is that government would never default. And banks also would want to invest in the government securities instead of the corporate bonds, because the risk weight attached to the government securities is zero. So no matter how much of amount of money that a particular bank invests in the government securities, it is not going to be calculated in its risk weight assets. We have seen this in the risk weight asset calculations. So it is not going to increase the capital requirements on the bank, irrespective of the amount of the investment it makes in the government securities. And that is why most of the banks prefer government securities over any other corporate bonds. And not only that, for SLR requirement, the banks are supposed to keep government securities. What is SLR? Statutory liquid ratio is a certain portion of the deposits must be kept in liquid form, either in cash, gold, or government securities. So to meet their SLR securities requirements, banks purchase government securities. So in India, the bond market is predominantly dominated by the government securities, and that lead to the crowding out of the private investments, or crowding out of the investment space for corporate bond market. So this is also one of the reasons for the shallow corporate bond market in India. And the other reason is lack of liquidity. What is liquidity? Liquidity refers to the ease at which a bond can be sold in the secondary market. That means if I purchase a corporate bond, I cannot keep the bond till its maturity. I may want to purchase or sell it to some other investor. But what if I don't find any investor in the secondary market? This is the problem with most of the corporate bonds. See, the institutional investors that we are talking about, the insurance companies, pension funds, banks, mutual funds, or high net worth individuals, whenever they purchase the corporate bonds, they cannot sell it in the secondary market, because there are hardly any takers for these bonds in the secondary market. So this lack of liquidity is also one of the reasons why there is less preference for corporate bonds. And the last reason is delay in the bankruptcy resolution. See, what is bankruptcy? If any company is defaulted on its payment, then it is known as insolvent, and once it is legally recognized under any framework like IBC, then it is declared as bankrupt. That means if a company, if an institutional investor or a retail investor invests in the bond of a company, if the company is in losses and defaulted on its payment to the bondholders, then the only way of recourse is to approach the IBC framework, because even bondholder is also considered as a creditor. Not just the bank, even bondholder is also a creditor, so they can also approach the IBC framework. But the problem is they don't have any hope with respect to the resolution under existing IBC framework, because as we have already discussed in the previous topic that there have been delays in the resolution even under the IBC framework. There is no hope of recovery. In fact, first whatever the money that is recovered through the resolution under IBC is given to the banks, and next in line are debtors. Next in line are actually these bondholders. So by the time they reach the bondholders, there is hardly any money that is left to be distributed to them. So the inefficiency with respect to the bankruptcy resolution is also one of the reasons why people do not want to risk their investment by investing in the corporate bonds. So these are the challenges with respect to the corporate bond market in India, and these are the challenges that are mentioned by the economic survey with respect to the corporate bond market. Okay, so as long as these issues are actually not resolved, we cannot improve the market for corporate bonds in India. So the last topic is rise in investor participation in capital markets. Okay, so economic survey has mentioned that the Indian capital market has witnessed a significant improvement in the investor participation, mostly aided by the growth of mutual funds. In the last 4 to 5 financial years, the participants in the retail participation in the mutual funds have been increased very significantly. In fact, economic survey has mentioned that the retail participation in the mutual fund has been almost doubled in the last 4 financial years. That means in financial year 2022, there are around 5 crores of SIP accounts in the mutual funds. Systematic investment plan accounts are there with the mutual funds, and that number increased to almost 10 crores in financial year 2025. As of today, there are more than 10 crore SIP accounts in the mutual funds in the economy. This is a significant improvement, 100% increase in the last 4 to 5 financial years. So in this context, mutual funds become very important for this year prelims. Okay. So we'll discuss about the mutual fund and how does it function and how does it work, and we'll wrap up the discussion. Okay. What exactly is a mutual fund? A mutual fund is a collective investment scheme which attract investments from large pool of investors, and they manage a fund by a fund manager. The fund is actually managed by a fund manager who makes the investment in multiple assets and make the revenues, and the revenues are distributed back to the investors. And this entire process is actually managed by an asset management company. Simple. Let me explain you how does it work. For example, let's take an asset management company. An asset management company launches multiple mutual funds which meet the requirements of multiple types of investors. For example, certain investors are actually risk prone, certain investors are actually risk averse. So to meet the risk appetite of all kinds of investors, different kinds of mutual funds with different rate of returns are actually launched by a single asset management company. Okay. So when the investors are investing, they invest in a particular mutual fund, but not in the asset management company. The investors are actually investing in a particular mutual fund launched by the particular management company, but not in the company itself. Let's say certain investors may invest in mutual fund A, some investors invest in mutual fund B, some investors invest in mutual fund C. So basically this mutual fund is actually a pool of funds created by, sourced from multiple pool of investors. And whoever invested in this pool of fund, they will get units. They will get units. The units are given, the number of units given to each and every investor is in proportion to the investment made to the mutual fund. When this fund is invested in multiple assets like equity or debt or gold or any other infrastructure asset, etc. And when they make profits, the size of the fund is going to be increased. When the size of the fund is going to be increased, the unit value is going to be increased. The unit value of each and every unit held by the investor is going to be increased. If the fund size is going to be shrinked because of any losses, then the value of the unit is also going to be reduced. So that is how a mutual fund works. So what is the advantage to the investor? The investor who contributed to the fund in the first place, he will be given with certain amount of units. Depending upon the size of the fund, that means depending upon the performance of the underlying assets, the size of the fund is going to be increased or reduced. Depending upon the size of the fund, the value of the unit is going to be either increased or reduced. So if the size of the fund is increased, the value of the unit is also going to be increased, and the investor actually can redeem these units. Investors can actually redeem these units. Where do they redeem these units? They redeem the units from the same infrastructure, so same asset management company. That means the units are provided by asset management company and also they're sold to the same asset management company. That means there is no management or no involvement of the any trading platform, or there is no involvement of any stock exchange in this normal mutual funds. Okay. Now there are multiple types of mutual fund. Mostly there are two types. One is open-ended mutual funds and other category is close-ended mutual funds. Open-ended mutual funds are actually those funds which do not have any maturity date, and the units of these funds can be purchased by the investors directly from the asset management company at any time, and they can also sell it to the asset management company at any time. But these close-ended mutual funds, for them there is a specific date in which the asset management company, specific duration or specific time period in which the units are actually sold. If at all beyond this specific period, if any investor would want to purchase the units, then they will have to purchase that units in the secondary market in the stock exchange. That means for open-ended funds, there is no secondary market. Purchasing of units and selling of the units is directly undertaken with respect to the asset management company. But for close-ended funds, purchase and selling can also be taken in the secondary market. Because since there is a specific duration in which the units are directly sold by the asset management company, if at all anybody wants to invest beyond that specific duration, they will have to purchase from the existing unit holders. They cannot purchase directly from the asset management company. The existing unit holders can sell these units in the stock market to any other investor in the secondary market. So this is about the broad understanding of mutual funds. Let us solve a very simple question on the mutual funds. Question number 16. Which of the following statements are correct about mutual funds? Mutual funds are collective investment schemes exclusively meant for high net worth individuals. This is wrong. Mutual funds are collective investment schemes that are not exclusively for high net worth individuals, but they're for large pool of investors, including retail investors. Okay. Units of open-ended mutual funds are traded on the stock exchange. No. Units of the open-ended funds are directly purchased and sold to the with asset management company, and there is no secondary market and they are not traded on the stock exchange. but units of the closed-ended funds are actually traded on the stock exchange. Mutual funds are regulated by SEBI, right? Mutual funds are regulated by the SEBI. So only 3 is right. Answer is D. So that's it with respect to the dynamics of the capital market, which was actually discussed in the economic survey. With this, we have completed the chapter 2, and the rest of the topics will be covered by the Baswa sir as usual. So thanks. Let's meet again. Thank you very much.